Good afternoon, everyone. Welcome to the Business Case Finals. I'm Yi Wen-sun, and I will be your host for today's session. First of all, congratulations to all the teams who have made it to the finals. Your hard work and dedication have brought you here today, and we are excited to witness your performances. Before we officially begin, please allow me a moment to go through some important announcements and guidelines for today's session. Each team will have 10 minutes for their oral presentation, followed by a 10-minute Q&A session. Time reminders will be given by our staff from the front of the stage when 5 minutes and 1 minute remain. Please pay attention to these reminders and manage your presentation time accordingly. To ensure a smooth and enjoyable experience for everyone and avoid disrupting presenting teams, please keep all electronic devices on silent mode and moving in and out only between presentation rounds. Raw points of the business case final round may be disclosed during the business case finals. Most importantly, we kindly ask everyone to show respect and encouragement to every team throughout the competition. Thank you all for your understanding and cooperation. Now, before we begin the presentations, let's first get to know our judging panel for today. Our juries today are Dr. Jessie Jiang, Senior Teaching Fellow of International Business School Suzhou IBSS at Xi'an Jiaotong Liverpool University. Welcome. Professor Zhang Kun, Executive Director of Center of Innovation and Entrepreneurship, Director of Executive Development Program, Peking University HSBC Business School. Welcome. Mr. David Wan, Branch Manager of HSBC Bank China Company Limited Shenzhen Branch. Welcome. Mr. James, CEO of Alpha Holdings Limited. Welcome. Ricardo Morera, Sourcing Director at a leading European retailer. Welcome. Thank you to all our honorable juries for being here with us today. Let's give them a big round of applause. Now, the moment we have all been waiting for. Let's officially begin the business case finals. Our first team is ready to present their case. Please welcome Team Mexico to the stage. Team Mexico, the floor is yours.
Good afternoon, Mexican government and fellow spectators. We are the Mexican team, and we're here to show you that building a special economic zone in Mérida Progreso is an excellent way to reduce inequality in Mexico. Mexico is a region that has enjoyed stable economic growth, but certain sub-regions, for instance, the southeast in which Mérida is located, have lagged behind. Therefore, building this special economic zone is an excellent opportunity to provide formal job opportunities for the people of the region and to exploit their competitive advantages for growth.
There are four main stakeholders for this project. First, the federal and state governments. These governments will make sure that these supply lines work fine and implement all the policies and the infrastructure. The companies, these are our major sector in our project and are required for it to succeed as they are anchors and provide the capital. The people of the peninsula, they will benefit from the built infrastructure and the jobs generated from the project.
For creating our models, we use three main assumptions. The first one being that the political landscape of the Mexican government at all levels stays the same throughout the project. This is because we want to avoid delays. Second one is the exchange rate between the USD and Mexican peso being 18.3 pesos for $1, which is 10% higher than the current rate. And the third one is that the real GDP growth rate will be 2% constant throughout the years after 2032.
Before we landed on Progreso, we looked at three other major capital SEC cities that could become really powerful. So first one is Tijuana, then Lauderdale, then Veracruz. The two northern cities obviously benefit from trade with the US, but they are both in high insecurity, unsafe regions. Then Veracruz is already developed and is one of Mexico's largest ports, so it isn't really ideal for an SEC. The case for Progreso is very different.
It's very different because we have two main factors that make Progreso much different to the other cities. First, we know that in Progreso there's a lot of cheap labor because of the informal workers. So when we put the SEC in Mérida Progreso, we're expecting this informal market to transfer to the SEC. Now, it's also known in Mexico that Mérida and Progreso is the most safe city in all of the country, so that is very important for all of the investment because the foreign investors want to have the security that they're going to have no problems there.
We must also not forget that the port is located in a very strategic position because with the new infrastructure in the Istmo de Tehuantepec, Progreso is a very important port in exporting manufactured goods produced with inputs from China. Moreover, it has access to Caribbean markets, South American markets, and European markets, with which they do both importing activity and exporting activity, and we're looking to capitalize on these routes. Moreover, there is currently a small project which resembles special economic zones, which includes two industrial poles which benefit from tax incentives, including income tax, 100% income tax exemption and 100% value-added tax exemption, including benefits for depreciation.
Now, finally for the project. This project is divided in three main parts. The first one being the infrastructure, which will be built before applying any type of policy to avoid any ghost towns or any other type of problems. The policy will then be the second part, applied by the government to do tax reductions and VAT reductions. And supply chains. Supply chains are incredibly important for a product as the supply chains with the US and with Europe and with South America are very important to how much this project will earn. Then there's the expanded SEC. This is the zone that we decided to do the special economic zone. This is a bit east to Puerto Progreso as to not disturb the locals or add them with extra traffic, with contamination or anything of that matter. This zone is divided in three parts: the green belt, which is an ecological zone, the infrastructure and the energy that will be a part of the zone. Also, it is important that all this abides by Mexican building laws, labor laws, and other laws.
But well, it is important to remark that to carry on a project like this, it is very crucial to have the right policies. First of all, we have created a plan so that the government collaborates at all levels, federal, local, and state, so that the project can ensure its future. Then there will be the tax breaks, as mentioned before. We will extend it for a longer period of time to incentivize inversion. Also, there will be an incentive for being formal labor, as Mexico has a big problem. More than 50% of employment in Mexico is informal. And finally, the construction of the special economic zone will not begin until there is at least 2 anchor firms secured to prevent lack of capital investment.
To To better understand NCC's and our project, we took a look at two real-world success examples. The first one of which being Jebel Air Free Airport, which has a similar sector progression to what we would want in Yucatan. But we do recognize that Dubai has a major geographical advantage, and so we took a look at our second option, Tanger Med for Morocco, which moved from the periphery to a major import hub because of inserting itself into major global supply chains.
The environmental pressures, as mentioned before, the ecological buffer zone is something required by Mexican environmental law to be applied to industrial zones close to any environmental zone. But these types of measures don't actually prevent that all the flora and fauna will be safe or nothing will happen to them. Therefore, to mitigate risks, we will be utilizing clean energy that is produced in this exact zone and throughout the peninsula.
We are going to separate the whole project in two phases. In the first phase, we're going to make all of the capital expenditure from the government. Like in the first 3 years, we're expecting to be building all of the roads in the city so that when we start with the development, we don't have problems with traffic, for example. Also, in this period, we're expecting to make all of the contracts with the anchor firms so that they can start very early on the second phase. Now, on the second phase, what we're going to do is start all of the tax policies, and then in this period from 2030 to 2056, we're expecting all of the firms to enter the market in the city.
These are our anchor firms. These are modeled after real proposals of investments made by local firms in the region. So it's a grand total of 200 billion pesos.
At the beginning of the project, we were expecting all of the higher costs because of what I explained of the first phase. Now, at the end of the project, we are having much less costs because these costs represent the tax exemptions that we are making. So at the beginning, it's very high, and then it lowers and it's stable.
Capital structure of the project, we will use 70% debt and 30% equity. The equity part will come from the fiscal budget of the Mexican government, specifically the Fund for Special Economic Zones that is already contemplated in the budget. And the debt part will come from specialized international banks that focus on developing underdeveloped areas in Latin America. This is great for us because they will give us a lower rate than the one that we would obtain if we were to issue Mexican bonds to cover for the debt.
Our growth is based on two-phase vast diffusion model, which is based off of local physical capabilities and P and Q coefficients chosen to match historical trajectories of nearby development in other similar regions.
Yeah, we've measured impact by looking at Merida's GDP, and we have 3 scenarios which range from around a 45% GDP increase to around a 60% GDP increase.
We have 3 main risks: capital, social, and environmental. And our mitigation taxes would be to be tied down to the anchor firms, as mentioned before, for the capital, to invest in public infrastructure for the social, and to use the buffer zones for the environmental.
Therefore, the government budget losses would just be of 41 billion pesos, while the growth will be of 284 billion pesos. Therefore, no matter if it's the positive or negative result of this project, it is incredibly useful as it reduces inequality and it increases the industrial output of a lower income area. Thank you.
Thank you for your presentation. Your presentation time has ended. We will now move on to the Q&A session with our juries.
Thank you very much. So my question is about the competitive landscape of the similar economic zone in Mexico and maybe other Latin American area. So have you considered what's the advantage and disadvantage of this proposed zone as compared to other similar zones So, and why you think this will be successful?
Okay, so well, so one crucial part of why we chose Progreso as the zone for developing this is because of its very strategic location in global trade routes, which I will show in a bit. Okay, so Progreso, as you can see, is located over there, which is in the Yucatan Peninsula. But the competitive advantage that Mexico has, that it's that we have connection with both oceans, both the Pacific and the Atlantic Ocean. Actually, there is a train that is called the Interoceanic train that comes from here to here, but also it connects with the Yucatan Peninsula. So we're taking advantage of that to make Yucatan become a crucial point for global trade routes, as it allows Asian markets and also South American markets to access the east coast of the United States, Europe, and well, even the Caribbean and South America if they come from Asia.
Additionally, compared to the other options we proposed, this is the one that most makes an effect on the area and the inequality of such area. For example, the GDP growth will be percentually so much higher in Yucatan compared to the other zones, which can experience bottleneck effects as they have already grown enough and have other things that motivate their growth.
Yeah, and when comparing to other Latin American regions, for example, Panama stands out. And Panama's advantage, of course, is a canal, and they reinforce that through a special economic zone. And we have quite a similar scenario that can't replace the Panama Canal, but that it's actually complementary, because there's a train in the Istmo, which is this small region, which has been used to transport time-sensitive cargo that cannot pass through the maritime route down the Panama Canal. So in that sense, we're using Progreso's competitive advantages and other competitive advantages in the southeast to compound a wider strategy that can compete with other Latin American countries.
Hi, thank you for the thorough presentation. I'm very interested to better understand the financial stability and feasibility of the project. Can you talk a little bit about whether you think this is going to be sustainable on a short-term and long-term basis, maybe from a cash flow basis, and how to consider the, I guess, investment returns of this project from the equity perspective?
Yes, we are making all of these way of mitigating the risk for the capital investment by like making this in two phases. We can just in the first phase develop all of the urban part of the city, and if in any case we find out that the SEC might not even work, we can just cut it down and just decide to not go for it. But if we do decide at that point in 3 or 4 years that we can do this project, then we'll go on and make everything. That's a very good way to mitigate the risk.
Something that is important to add to this is that most of the infrastructure projects that are being carried in the area were going to be carried out already by the Mexican government, so they are already in the budget. They don't constrain the budget of our projects.
Yeah, the only elements that actually constrain our budget and for which we've allocated the specific special development zone fund of the government are the infrastructure around the zone, particularly highways for greater connection in the coast, and as well the industrial complex. Yeah.
Okay, hello. I believe you had a slide where you showed already the map of which industries you wanted to have in the special economic zone. If I'm not mistaken, aerospace took up a big chunk, and I saw now also that your most optimistic is also aerospace. And the two special economic zones that you use as a benchmark, none of them do aerospace. So how do you forecast that the the biggest chunk of your economic zone is aerospace. Where do you think that's going to be absorbed? Because I believe, especially your close neighbor US, very hard to become a supplier because it's considered defense, and so out of US supplies are very hard. So where are you planning to send all of that demand of a 20% allocation of the zone for aerospace?
Okay, so first of all, it's important to remark that aerospace industry is already the first industry in exports from Yucatan currently. Now,
Yes, so there's already a large sector of aerospace. Obviously, it doesn't employ as many people as agriculture or similar industries, but if we went back to the slide with the gross economic output per worker, it is certainly one of the highest. So the productiveness of the aerospace industry really makes it stand out above the others. It won't be a huge sector, but right now they focus on harnesses and turbines. Harnesses, obviously, there are not as time sensitive as other things, so they're really flourishing in the maritime trade in Yucatan. And turbines, well, because it is very well connected to not just the United States but to the rest of the world, is a really good strategy to depend a bit less on exports to the US, and it's just a risk mitigation hopeful scenario, because as we see the weights of the different industries changes between scenarios. In the base weight we took the most probable, that is to continue the natural things that are already happening in Yucatan, but we do see a shift to aerospace because that's our optimistic scenario.
Right, thank you very much. And I was just wondering, intuitive questions. You know, you've identified a zone to expand, but in terms of the current situation, what are the hurdles? What really restrict the current, size?
could you repeat the question, please?
I mean, you're trying to expand a port, right? What is the current hurdles of doing so, of expansion, in terms of the restricting factors, and what are the remedies?
One of the main restrictors is the environmental factor. Yucatan and the whole peninsula is known for its huge environmental and natural reserves. So building is usually a very big problem, but we have especially selected a zone, as you can see in the map, that has no really federally protected land and is owned mostly by the government. This zone is exactly to mitigate that risk, that a lot of projects have been shut down in this peninsula because they have tried to break down the environment and they have been completely shut off.
It is also important to mention that the expansion of the Progreso port is also one of the infrastructure projects that the Mexican government is already carrying out, which is also a part of why we chose this place, because we want to take an advantage on the fact that the Mexican government is already implementing a lot of new policies regarding infrastructure in the zone.
Well, so congrats for making it to the final, right? That's how I started. So, quick question. You mentioned 20-year tax-free, right? So what would be then the main sources of revenue for this SEZ, right?
Yes, there's of course not going to be a lot of revenue because of the nature of the project. Our revenue is in the economic study, because we're going to have a lot of economic spillover in this zone, and we're expecting to have a lot of growth in the city.
Yeah, it's also important to mention that this is like the whole Yucatan Peninsula, and as you go to Veracruz, is all a zone that is greatly developing. So the spillover effect and of the investment in Merida, we are prognosticating that it will sprout growth in nearby areas, which of course brings revenue.
Thank you. You may return to your seats. Our judges may now proceed to this one. Our next team, Team Switzerland, to the stage for preparation and technical check. You can now start your business case.
Good afternoon, I am Domantas and these are my teammates Elihu, Eric, Kashi and Harry. And we are Team Switzerland. Switzerland is known for its neutrality and safety. And today we are presenting a solution that we have named SAFE, Switzerland's Alternative Fund for Enterprises. So, social economic zones are great for development. However, they provide little incentive for innovation. Given that Switzerland is already highly developed, constructing a special economic zone would simply not be viable. As such, we have considered a different, unique angle, and that is to better fund our startups. That is precisely what SAFE will achieve. We consider that our solution will have a significant impact on our economy and will spur, accelerate, and motivate a field that is currently underperforming. Now, let's better understand our country. Switzerland already has a highly optimized economy. Firstly, we have highly specialized output, focusing not on volume, but on high-margin specialized industries. Furthermore, we have an elite pool of talent, benefiting from our educational institutions such as ETH and EPFL, allowing us to have a very skilled labor force. However, we do pay premium wages for it. And lastly, we have decentralized tax competition among our provinces. As such, Switzerland does not need a federal tax haven, such as a special economic zone, as there is 26 provinces actively competing on the tax rate.
Now let's analyze the viability of implementing potential special economic zones. We modeled this entirely from the demand side. Would firms join if we implemented special economic zones? We created a model calculating surplus compared to the alternative option of continuing operations in standard conditions. In developing countries such as China, we calculated huge surpluses such as 56.2%, or exactly in developing countries. In very well-developed countries such as Switzerland, there is not that much of a potential to be won because we are already very well developed. We calculated a surplus of 8.7%. These 8.7% would not attract enough firms as it doesn't cover the cost of friction. We even have a proof of concept. Our canton of Zug is probably the closest we can get to a special economic zone, and it has very low taxes, which means it should attract a lot of firms. However, they still lose against Zurich or Geneva, which are major hubs, without that big of a surplus. That means the cost of friction has to be pretty high. And this is actually identical everywhere in Switzerland. We have analyzed 7 vastly different regions in Switzerland and come to the conclusion that we cannot reach a surplus of higher than 15% anywhere in Switzerland. Special economic zones are mathematically not viable.
So as Elihu has said, special economic zones are practically obsolete in the West. And why is this? At the end of the day, a special economic zone is supposed to drive growth. It's supposed to use high levels of capital as well as labor and land to boost economies such as manufacturing and services. But the issue with Switzerland is that it is already so well developed. These industries are highly mature and they don't need much help. If we want to find somewhere to really grow our economy, then we need to look elsewhere. And where? In the quaternary sector. So this would be in tech and R&D. But the issue is that SEZs don't develop this. We need a different tool to go this path. And there's one tool that is actually surprisingly similar to an SEZ, and that's startups. They also require a high amount of investment upfront, with a lot of risk, but also an incredibly high upside. But the issue that Switzerland is facing with its startups, as well as much of Europe, is that they do not get enough capital. Many pension funds and investors are reluctant to go and allocate their money in venture capital. And Swiss startups therefore face significant funding shortfalls versus their American counterparts. And this is why the Swiss Startup Association and the European Investment Bank call a lack of capital the biggest challenge for Swiss startups.
What Eric has just proven to you qualitatively, I will quickly prove to you mathematically. We use the Cobb-Douglas production function to dissect output into productivity, capital, and labor. And as Domantas has already explained, labor is highly skilled, and we are also very productive. So if we can boost capital even more, that's exactly how we achieve output. Knowing this, we have figured out that we are in search of capital, but actually, the capital we are searching for is already in our own pockets.
And now, I will teach you how to take it out and use it. So here's the current status quo. We have some startups and we have some venture capitalist funds that provide the funding. But there aren't really that many of them and they don't have enough money. In order to fund our startups better, we need to fund the venture capitalists. And we do this by introducing a fund of funds. We will get a commercial state-owned bank to create a fund that allocates money to specific venture capitalists. This makes it easy to access the sector without needing in-house specialists and helps mitigate the risks, making it more safe. In order to provide an initial market, we will take state-owned banks and have them commit 1 billion Swiss francs in annual funding towards this fund. This helps get the ball rolling, and after a few years, once the fund is established, we can have other private investors, such as insurance companies, other commercial banks, and pension funds, chip in small amounts into this fund. Once we have reached this stage, we are golden, and the fund is sustainable in the long term.
Now, if we look at the individual stakeholders, we can see very clearly that they have a lot more to gain than they have to lose. As for the startups, they would have a lot more funding and be able to grow where most startups fail, in the pre-IPO phase. As for the venture capitalists, they would be managing a much larger pool of funds, allowing for economies of scale. For the fund managers, they would gain management fees, but also if they invest directly into the funds, they would have capital gains. As for the private investors, they would be able to diversify their portfolios and also have higher returns. The only pain point being that they have more exposure to risk.
As Kashfi just mentioned, it's the investors that are taking the risk, and that's why they need to be compensated. We created a capital asset pricing model to determine the required rate of return. As you can see, 14.84% is quite high. This is because of the size premium, liquidity premium, as well as higher systematic risk. To test if this is actually achievable, we ran a Monte Carlo simulation. 40,000 iterations over 10 years proved that the expected return is 15.2%, thereby fulfilling the requirements. Even in 52% of the scenarios, we outperformed the requirement. So, our model is financially viable. But let's look at a real-world example. Germany issued a similar fund by letting pension funds invest, by floating it on the stock exchange, and by educating regular investors. As the financial minister said, it was quite a success, as they outperformed many American counterparties. It allowed Germany to create a great return, and they're on the way to achieve the goal of 12 billion in funding by 2030, 70% of which will be financed by private people. They even launched a second fund.
Now, evaluating the risks that our solution poses, we see that the majority of funds would come from private investment.
The problem that here we could face is that the investors don't have enough confidence in the funds. And we mitigate this risk by using the anchor investors, so the state-owned commercial banks. As for the higher financial risks that startups have, we mitigate this by pooling the funds and creating our safe fund of funds. Currently, the Swiss VC market is rather small, but we do believe that if we push enough capital into the system, that VCs would naturally come in from domestically as well as abroad. There's also the possibility that the state bank reject the idea of actually creating the funds themselves. In this case, the federal government could come themselves and manage and create the funds, and propose that the cantonal governments be the anchor investors instead of the cantonal banks. And this is exactly why our solution is SAFE, the Swiss Alternative Fund for Enterprises. We thank you very much for listening and are open to any and all questions.
Thank you for your presentation. We will now move on to the Q&A session with our juries.
All right, thank you for offering an alternative to the SEZ. Right? So very interesting. I just have a quick question about your mechanism of creating a FOF, supporting VCs, then supporting the startups, right? What if the startups fail? And how much time are you planning to give the startups? Do you have a duration in mind? And what if they fail? How are you going to answer to the banks?
That's a really good question. So the question, can they succeed, is very important. In our model, of course, they have, but there's no guarantees. We believe that the chance is very high, as the VCs are professionals in the industry and have an incentive for these startups to be the correct ones. The initial funding is provided by the government, to be exact by the state banks, and it's actually a very small part of the balance sheet. It's less than 0.125%, and due to the long run period that it takes for the startups to pay off, time will show if it will work or not, but the chances, as we've seen from Germany, but also from VCs in America, are quite high.
So to piggyback about this, you said that startups might fail, and this is obviously taken into account. Around 60 or 65% of Swiss startups fail, but we baked this already into the Monte Carlo model. So even with the risk of startups failing, our project is still profitable, and that's why we think it is viable despite the risks.
Did you check any sensitivity analysis if you alter the 65%, say to 80% or 90%, would the number or the percentage and proportion change?
That is a really good question. So we base our number on the research that Eric just mentioned. And of course, if there's a big recession, there is a possibility that in the short run, the startups might go bust. But as the capital is not allocated all at once, but spread over time, the risk is highly reduced.
Thank you. So, according to my understanding, usually the banks is kind of this kind of risky business for banks, right? I think the banks in Switzerland also run on commercial terms. So, by your suggestion that you can use the state-owned banks as the anchor investor to start up this fund. So, can you elaborate a little bit about the environment in Switzerland? I'm not quite familiar. Is the government using administrative order to order the banks to participate in this risky business?
That is a really good question. So of course we consider the risks for the state-owned banks. The way we've structured it is that they commit 0.125% of the balance sheet to the fund, which is very low. So if the fund fails, it would be devastating to the banks. To the question if the state can order the banks to do so, the way Switzerland is structured is that we've got a federal government and we've got state governments, and the banks are owned by the state governments. So it would require the buy-in from the state governments to achieve this project. But as we mentioned before, if they decline to participate, which we don't expect, as there's been a few commercial banks in Germany that have done quite well out of the German startup scheme, there is still the possibility to finance it out of the government budget. So not over the banks, as we elaborated, or Kashi elaborated in the risk scenario.
I'm curious if the lack of capital is a real issue for funding the startups here, because given the cost structure in Switzerland, do you think startups are competitive versus, let's say, other parts of Europe?
So normally when capital doesn't flow to an area, it would imply that that area is unprofitable. And it might be easy to make that assumption, and it's very, very logical, but there's a bit more underneath. So if you think of a pension fund, right? Right now in Switzerland, they only invest 0.03% of their assets in venture capital. So if you are a pension fund and you have such a minuscule amount of money going to venture capital, you're not going to have many venture capitalists. And this is why a lot of commercial entities lack the in-house expertise, and they don't explore this sector at all. The thing that we fix is that we bring the scale up so that it is easier for these entities to invest. Once we have a fund, they don't have to buy in-house talent, and they don't have to bet on very specific companies with a very small investor base. But if they buy into this fund, they can diversify their risks, and they don't require in-house talent. So we think by reducing these frictions, we gain an advantage that shows that Switzerland does have good startups, but the issue is not that they're unprofitable, but just that there's too much friction for the existing entities.
Right, thank you very much. I understand that you have identified the capital in the production function to work with. I was just wondering if you would consider the technology shock, like say more real side of the economy, in terms of the current technology trend, and also linking to the real side of the economy, what kind of the profiles of the firms that you're aligned with. These kind of considerations.
Yeah, so if I understand it correctly, that is maybe talking about the productivity of capital, of factory productivity basically. And our assumption behind this is that if we have a lot of capital and a lot of labor, we can efficiently combine this, and it will, in the short run, productivity will be fixed, but in the long run, it is a self-boosting effect, kind of, boosting the productivity up, and then a shock would have a smaller effect on the total output.
Also, adding to that, we must consider that startup is quite competitive, and there's a lot of incentives for startups to go to Silicon Valley. And if they know that they won't get much capital in Switzerland, Swiss founders might just start in America. And by providing capital, we can boost our team, and as a result, boost the positive externalities for the whole business society.
If I may, for a follow-up question, you mentioned about startups, so what kind of profiles of the firms that you would prioritize or you're looking to?
So Switzerland has a lot of different startup industries. So, for example, we have some in embodied AI, we have some in food technology, we have some in green energy. But we won't really choose which one because we want to allocate this to venture capitalists and let them choose what they want to innovate. But anything that brings growth to Switzerland is good, and we shouldn't restrict ourselves to certain sectors or add excess bureaucracy. So I think it is best if we make the fund very free and allow venture capitalists to invest anywhere as long as it brings good returns for Switzerland and innovation.
Okay, first of all, congratulations to the Swiss startup community if only 65% of them fail. I think there's a correlation between how many fail in the first year versus a longer extended period of time, but I will trust that it's only 65. And if that is the case, you also talked about your expected rate of return for VC would be about 15-point-something%. Did you explain the periodicity of that return? Is that like yearly return, or is that like total return on the investment?
That is a yearly return. Sorry for not specifying it in case I forgot. So the way we've structured this is we've made the Monte Carlo simulation based on the distribution of startups that fail, so 60%, startups that do okay, and then startups that do very well. So we really try to emphasize the real distribution here, and we built it into a J-curve. So for people that might know private equity or venture capital very well, you can't go and invest 100,000 francs into a startup and then get 110,000 back in the next year. Often it takes 5 to 10 years for the capital to actually get given back by the startups, and we've considered that in our Monte Carlo simulation.
And this was also benchmarked against what the VC expected returns are?
We benchmarked this based on the capital allocation pricing model. So we use the beta based on studies from America, and we use the equity market premium based on studies from Switzerland, and we used illiquidity premiums as well as size premiums to accurately reflect it. The most of the information is from PwC Switzerland and also American VCs.
Thank you. You may return to your seats. Our juries may now proceed with your scoring. Now, let's welcome our next team, Team Singapore, to the stage for preparation and technical check. You may now begin your presentation.
Good afternoon, judges. We are Team Singapore, and today we'll be presenting our project, the Meridian Corridor. This is our agenda for today. And now, to give you a broad overview, traditionally, special economic zones cluster firms in a specific geographical location so that the firms can enjoy lower transport costs as well as economies of scale. However, in the age of AI, things are different. We are no longer transporting physical goods or material goods. Therefore, our team sought to reinvent the idea of a special economic zone specific to the AI age. This would mean decentralizing an economic zone over different regions where we tap on different comparative advantages that these regions offer. For example, we plan to train the AI models in Ordos, where energy is abundant and cheap. We plan to develop the AI models in Shenzhen, where talent and skilled labor in AI is concentrated, and distribute it internationally through Singapore, where we have deep-rooted trade networks to ASEAN, as well as a trusted, strong governance.
Alright, so the big question is why AI and why specifically through Singapore? So we can see that there's a high growing demand for generative AI, especially in regions like ASEAN, and China has that capacity, that spare capacity to supply that demand. And what our project does is simply it connects these two key areas together to facilitate this process. And what it does is it relies on cross-border institutions and captures local synergies in China's economy. Now, a key concern arising from all of this is that ASEAN countries may be hesitant in adopting these Chinese AI models due to sovereignty issues. However, viewing sovereign AI as solely owning an entire technology stack, rather than doing that, we believe that it would be more pragmatic to reframe sovereignty around having the ability to govern this AI technology. Next slide. So, this slide overall gives a brief snapshot of the key tailwinds and headwinds facing our project. And I would like to focus a bit more on the political aspect of the US-China rivalry, where Singapore comes in to play a key role as a third-party neutral government that can help extend China's reach in both ASEAN and AI as a whole. Now, from an economic, social, technological, legal, and environmental standpoint, the evidence suggests that our project is highly feasible and highly beneficial.
Okay, so now going to our solution over here, we tend to take the advantage of the comparative advantage of the three different locations, namely the Orders in Inner Mongolia, Shenzhen in China, and also Singapore. So in Orders, there's abundant natural resources that's currently being underutilized due to the lack of people in Orders. And in Shenzhen, we're hoping to take advantage of the existing digital ecosystem that is highly developed and has allowed it to become a global financial and technology leader. Singapore's reputation and ideal geographical positions it well to act as our accreditation hub. So we are hoping to use a regulatory framework across all three nodes. So for orders, the main policy over here will be the compute rights ledger, which allows the rights to use computational power to undergo computational tasks to be traded. For Shenzhen, this will be the jobs and tax engine, and it will allow us to take advantage of the digital ecosystem as mentioned earlier. And finally, for Singapore, this role as a neutral governance and also its international standing allows us to mirror the Douyin TikTok model, which is to reduce political risk. So as you can see over here, so all the three different nodes are all structurally linked but are risk independent. So this helps to reduce overall risk to maximize production and minimize downside risk. So here's our action plan. We are dividing into the three nodes and 3 phases over here. So 3. So for the first phase, we're hoping to establish some basic capacity so that we can get the scheme to start production to a certain extent. Once we hit the first checkpoint over here, this is a 60% uptake. We can then proceed to scaling up the scheme to increase production, and once that scaled up, it has reached a lot of utilization over here, which is the second checkpoint. We can then proceed to maintain sustainability in terms of hardware, fiscal sustainability, software, and infrastructure.
Thank you, Nathan. Now, for comparative analysis, we aim to benchmark the feasibility of our program through 5 yardsticks, which we have above. Now, first for P, positioning and national interest, we aim to design this distributed, decentralized economic zone such that it gives each of our stakeholders an advantage. For China, it gives China a chance to become an AI model frontier development leader by distributing through Singapore to internationally. It gives China's AI models a chance to compete neck to neck with US models. For Singapore, it supports our SG60 vision to become a regional AI leader. And for ASEAN, governments will also be given an equity stake in this project to incentivize them to promote AI adoption in their countries. For R, realism and economic feasibility, our project is well aligned with China's East Data, West Compute framework, which actually reallocates energy-intensive activities such as compute to the West, which is energy abundant. Now, for institutional and governance, like Nathan mentioned earlier, this also performs well because we are using a tried, tested and proven method, which is to expand internationally through a dual hub strategy, where Chinese firms such as ByteDance, which is based in China, set up headquarters in Singapore in order to expand internationally. Now, for sustainability, our project also does well, with more than 80% of renewable energy that can be used for our energy-intensive compute. Why? Because in China's west, it is home to China's mega dams and gigawatt-scale solar farms, which span the deserts. And therefore, we'll be able to use this via green power direct supply. Now, for measurable risk and impact, not only will we have an impact on China, we'll have an impact internationally on Singapore and ASEAN as well. And in order to control the risk of this project, like Nathan mentioned earlier, right, we'll adopt the project into 3 phases. The first phase, if there's more than 60% utilization, then we move on to the next phase. And if there's more than 75%, we move on to the next phase. In a way, this caps the risks for our investors to stop losses should the project not work out. Why this is tried and proven? We look at China's EDWC as an example. Because it was state-funded, it led to overinvestment due to intra-governmental competition. We also saw some other issues that came up with US's Stargate and India's AI mission. For example, both are not green, or they do not use renewable energy as much as us, as well as the single buyer risk associated with US's Stargate.
So now I'd just like to bring you through the financial viability of this project. So I'll just highlight some headline figures. The project NPV is 1.36 billion, project level IRR is 13.5%, and equity IRR for equity partners is 16.8% due to use of leverage, which we'll cover later. So these returns are brought through 3 different special purpose vehicles. One is in Ordos, Shenzhen, and Singapore respectively. So just something I'd like to highlight over here is that I would like to reiterate, we are not operating the AI companies, we are simply setting up a special economic zone. So what does this involve? It involves governments partnering with, for example, private partners to develop infrastructure for these companies to succeed within these individual cities. So now, these are some information for the different SPVs. I'd just like to highlight some differences in the natures of the SPVs over here. So for Ordos and Shenzhen, it is more real estate infrastructure based compared to Singapore, which is more a platform and company, more like a regular company. So what this involves for the underwriting is that Ordos and Shenzhen will be more susceptible to things like cap rate changes, etc. And we can discuss the core underwriting assumptions later on as well. So this is a project structure. 3 of the SPVs are wholly owned subsidiaries of the HoldCo, and there will be investors for the HoldCo as well as lenders. And here's just a short diagram of our project financing structure over here, which we can discuss more later.
Okay, moving on to the sensitivity analysis, we have modeled out the base, bear, and bull cases, and across the 3 we have adjusted the rent fee rates, occupancy rates, as well as capex rates, yielding the NPV and IRR as shown. So moving on to economic development, for China, this helps alleviate regional inequality through improving income inequality and also fiscal sustainability. For Singapore, it aligns with its national interest in terms of AI and overcomes its energy and land bottlenecks. Lastly, for ASEAN, it helps improve their digital sovereignty, human capital deepening, and bridging the AI divide. These are the risks and the proposed mitigations. The 3 main risks we have identified would be demand shortfall, cost overrun, as well as anchor tenant concentration. And these are the mitigations that we propose. Thank you so much.
Thank you for your presentation. We will now move on to the Q&A session with our juries.
Okay, so thank you very much. Let me start with some easier questions. Right? So, could you help me walk through a potential client journey? Right? So if I'm one of the companies that's potentially being attracted to the Meridian corridor, where would I actually register my company, and where would I actually sort of send my people, my employees to, and how would these 3 different locations really correlate within my company in terms of my daily operation? Could you give me sort of a run-through?
Thank you for the question. So, there are different AI companies that can be involved. The first one will be data center companies. They will be going to Ordos. They will send their employees, the equipment to Ordos to tap on the energy grid that we'll be providing through our infrastructure projects. Now, for AI development companies, like AI models, like one could be DeepSeek, they would send and set up office in Shenzhen, where they will develop their AI models from there. Now, for the application layer of AI, we plan to do it in Singapore, where we'll be localizing these AI models to ASEAN needs. For example, ASEAN's languages, ASEAN's developmental goals, and these AI models will be fine-tuned in Singapore, and they will receive accreditation in Singapore to be exported into Southeast Asia.
Then a follow-up question is, what kind of companies are you guys really targeting? What kind of scale? With how many people? What's the revenue sort of in terms of the scale you have in mind? That will be the best fit for this design, for this zone.
I would say that for the scale-wise, it would depend on the different layer of the AI stack that we are looking at. So for example, on the energy scale, for data centers, we will preferably be looking for larger companies to take up office at Ordos, whereas and that's the same for AI models as well. But for AI application layer, which is done in Singapore, we would be open to having small medium enterprises as well, who have the expertise to craft this AI into really localized applications, such as for farming in the developing countries or other countries in ASEAN as well. Yeah. So my answer to you would be that it depends on the different layer of the AI stack.
And also especially because I'll just highlight the Shenzhen note here is because, as I mentioned earlier, there's already that digital ecosystem ranging from 2,600 companies and having 220 billion yuan of revenue. So we can utilize that existing ecosystem to really help to scale up the whole system as according to our action plan. Yes.
So the final follow-up question from me, right? So who is actually getting paid? Who is actually the main guy setting this up? The Singaporean government, the Chinese government, or Shenzhen or those municipal level, right? So I'm just trying to understand.
Okay, so who's actually setting all this up? So what we did in our structure over here was to have a whole developmental holdco over here. So this holdco will invest, will own 3 of the different SPVs, which are sort of like funds over here, just to invest in the real estate development or infrastructure development for all those in Shenzhen and for Singapore to set up the platform in general. So who are the main players here? Okay, so first we got like the governments. So of course we got Singapore and the Chinese government specifically as 2 of the major players. We can also see we also allocated some of the capital equity to industrial and infrastructure partners over here, because these are people who will be most able to gain from these developments as well. So they can also play a part in the development process.
Since you are aiming at, I would say, significantly larger companies that in some way I think they already developed the capabilities that you described, and let's not go that far. Tencent, they're already in Shenzhen, they already have an AI model, they already have access to the energy infrastructure, they already have an entity overseas. Why do they need this solution? What's the advantage compared to what already exists? What is the added advantage to going into a decentralized economic zone like this?
Okay, so I'm assuming that your question is really about the value add to private companies over here, and I believe that the value add to these private companies is really the access to markets, because I mean, the Tencent having an office in Shenzhen that is helping to build AI models is great for domestic demand, but as we already know, China's experiencing a domestic slowdown, the domestic demand is not that great. But using this system, these firms can benefit from having greater access to a growing ASEAN market where there's a lot of demand for targeted AI tools in terms of like agriculture. I think Indonesia is trying to do something for the agricultural plants, and then they have access to that market to sell their AI models to these people to really make, and then they will be able to get the profits of the AI models that they are selling to these other countries. So in that, this creates a win-win-win situation for both the Singapore government, Chinese government, ASEAN region, as well as these private firms that will allow them to really get this extra revenue from being able to sell their products to a greater region.
And do you think they need to go to Singapore to do that?
So just to quickly add on to Nathan's point, right? ASEAN is a region that's inherently unique. If you could go back to the slide of the MEC tree, right? That'd be great. So essentially, ASEAN is a region with vastly diversified population. You're looking at countries like Indonesia, the 4th populous country, right? Young people, mobile-first people, multilingual people. This is a unique intersection of 3 different capabilities that simply can't be replicated in another region, right? So that's really the value proposition we're bringing. And now going back to your question about why Singapore? Why does China need to use Singapore to access Singapore as a gateway to access ASEAN? Well, Singapore already has a bunch of legislative frameworks in place. One example would be Sea Lion AI, which is essentially an LLM that is basically already has frameworks for the different languages in the Southeast Asian region. So it's because of Singapore having the legislative frameworks and the foundation for AI, and it can really provide a strong foundational base for scaling this AI across different countries, across this diversified region of ASEAN. That's exactly why we're using Singapore as a gateway. Yeah.
Just to add on, because in this situation, Singapore has a very long history, both bilaterally and multilaterally, through the Association of Southeast Asian Nations. And there's actually a lot of different mechanisms, such as ITRA, an initiative of ASEAN integration, that allows for such AI models that are more suited for developing countries, which are the case for ASEAN countries, So in that sense, Singapore serves the needs of the ASEAN countries better.
Yeah, can you just summarize, you try to bring in collaboration with regions in China, right? So what could be the challenges, because China and Singapore have different landscape of, development and focus. So how do you, what is the cost there?
Yeah, as you rightly mentioned, that's definitely one potential challenge that really is a hurdle in this project's phase, right? So essentially, we've identified that institutions really has to be a stronghold of this project, and because you need not only cross provincial coordination, but also international coordination between Singapore, the ASEAN countries, and China. So I think, but we can see that this has been done before. There's a precedent for it, such as the Yangtze Delta Zone, that is basically an executive committee across 3 provinces in China itself. So essentially, we want to make sure when we are coordinating between provinces that they don't go in a subsidy race. They are coordinating their subsidies. They're not oversupplying subsidies and attracting companies that aren't necessarily competitive in the industry as well. So there's a lot of coordination that's at work, but this has been done before and it can be done again.
Maybe, just maybe. Specifically, there's one potential sector like the cryptos or Web3. Would you think that would be a focus that this special zone is better fitted for?
Okay, so if we were to go to the comparative advantage slide, actually in terms of industries, we were considering adjacent technological industries, but we weren't exactly doing crypto. My first hunch was actually robotics and other artificial intelligence adjacent related industries, because this is like a derived demand. You can use these AI chips to help power adjacent technologies, and then that can be used to generate further demand and further revenue as well.
Yeah, and we also have the Monetary Authority of Singapore, the Central Bank of Singapore, always having proven initiatives, sandboxes such as Project Orchid, Project Bloom in Singapore that gives AI companies, cryptocurrency companies a chance to set up and test their products in Singapore. So we believe that Singapore is also a perfect place.
Thank you very much. You may return to your seats. Our juries may now proceed with your scoring. Now, let's welcome our next team, Team China 1, to the stage for preparation and technical check.
Am I audible? Okay, good. So if everyone's ready, our time will start now. Good morning, honorable judges and audience. Yunnan is a province with thousands of years of history. And today, with CCP Consulting, we are able to unveil the next page of Yunnan's legend. Giving you an executive summary of our project. Our project basically revolves around 3 questions. First, should China develop new SDGs? Our answer is yes, and we want to develop highly novel and specialized ones. Second, where should we develop these SDGs? We believe that Yunnan would be the appropriate place for us to develop because it is close to Southeast Asian countries and it will promote export. Finally, how should we be able to develop it? We believe that the key is to upgrading and incorporating existing infrastructure. We managed to bring up 2 innovative policies. One that essentially turns Yunnan into a green industry and sustainable, while the second one turns Yunnan into a major logistics hub. The impact of this is profound. In a base case scenario, we managed to achieve an NPV of RMB 6 billion with a benefit cost ratio of 2.5 and about 40% reduction in median dwell time.
Thank you. Economic development zones are central to China's economic transformation. As we can see, currently China has 232 economic development zones,
and it creates 16.9 trillion RMB in GDP, as well as accounting for nearly a quarter of our trade. And next we see the classic examples of Shenzhen, Shanghai Pudong, and Suzhou Industrial Park, which of these are for financial centers and for hybrid manufacturing and R&D. Oh, sorry. And next, we see that for value creation, an economic development zone creates value through spillovers by creating benefits for the region around the zone itself, as well as being an experimental ground for legislations. And also we can upgrade existing supply chains. However, there are some issues with the traditional form of development zones, in which, for example, in cases where there are frictions with foreign countries in trade, we cannot solve them. That is why we propose our own measures of economic development zones. So we will reference these three in our following slides as well. The first is geographic, and the second one is the need for a new zone, and finally, economic suitability. And if we look at this graph here, this is a PPP graph from China. We see that Yunnan is the darkest, which shows high economic potential.
Now, introducing you to why specifically do we choose Yunnan, we have three key reasons. The first is that Yunnan sits at a good geographical location. It actually borders a lot of Southeast Asian countries, especially ASEAN countries. It has a massive infrastructure of railroads and highways extending thousands of kilometers. And with these benefits, it's able to generate 20% growth in trade in the 2025 fiscal year alone. That is quite significant. The second is that Yunnan has a rich foundation of existing platforms. We see that it already has 4 platforms ranging from a free trade zone to a low tariff zone that are in experiment. However, current problem exists because lack of coordinations. In this case, if coordination lacks, frictions will occur, which will result in investors losing confidence in Yunnan, and then money goes into spoil. We believe that we should truly find a solution that should solve this.
Now moving to the economic aspect, the first thing that comes up with outside is the abundant amount of the infrastructure supply even before the initial investment. One of such example is the railway that connects from Kunming to Vientiane and potentially going to Bangkok in 2030. And you can also recognize these nodes. They are very important. For example, the single track sections, and they play a crucial role in decreasing the logistical cost and increasing the efficiency of the international transaction. And next, moving to a more specific benefit and cost analysis of Yunnan. The first 3 advantages of Yunnan that we have located is comparative advantage, the investment possibilities, and also the infrastructure supply. Specifically, the industrial clustering can convert the Yunnan energy cost, and also the agricultural products cost to decrease a lot. And also, the shared facilities that we introduced in the last page can decreases the cost of the trading and the fixed cost, and at the same time increases the initial investment incentive. Although we have also located some of the costs, for example, the cost of the integration, the potential risk of coordination, and the population drift that may decreases the demand. However, our policies that we'll explain later tackles all of these costs specifically and directly. So given these benefits, we do believe that building the economic development zone at Yunnan is a feasible and suitable plan.
So today we brought you 2 main economic policies. So the first policy, policy A, is a domestic one. Second, policy B is an international regional one. So policy A aims to build industry, a stronger industry in Yunnan through infrastructure, skills, and finance. And policy B aims to structure the connection between Yunnan and the Asian countries through real, also customs and partnerships. Next. So here's our policy A. We know that Yunnan has a lot of technology and resources. But having a lot of this technology and research doesn't mean a lot if your value capture is not in Yunnan. So policy A directly solves this problem. First, we will have related firms who share upgraded facilities. Next, we will also offer vocational training for all the laborers in Yunnan. We also have support that is based on milestones, not just simply giving you money. And finally, we will also have a unified provisional approval office specifically for Yunnan's allocation of resources. Next page. So moving to policy B, the exciting part. It is called Southeast Asian Economic Corridor. Essentially, it is an investment in the railway network. As you can see, Kunming, the biggest city in Yunnan, at the start position. It is the starting position of a lot of, I think, 3 Pan-Asian trade networks. So there's a southern network that connects Kunming to Bangkok, which will open in 2030, another eastern to Vietnam, and finally a western network that connects it to Myanmar. So essentially, we invest in the joint railroad network and also the export licensing process under the Belt and Road Initiative, connecting ASEAN, and Yunnan together so that Yunnan can become the main economic link between China and Southeast Asia. Next. So, adding more to policy B, we have talked about building a railway network, but it's not that simple. There's another solution that we have to complement it. It's called OnePass. OnePass is a digital passport for trade. Once you have a verified shipping plan, you will have this document or either a QR code or even a basic serial number, so that you can pass this number all the way throughout your trade network. You don't have to have any other transaction costs, and this ensures the swiftness of the trading process. Yes?
We have the 3-stage implementation plan. From 2026 to 2028, we establish development zones, select 3 industries, upgrade existing sites, and from 2028 to 2032, we monitor performances, expand training, and pilot the export licenses. After 2032, the proven clusters and the Asian railway are scaled after proven. Yeah, next page please. When evaluating policy effectiveness, we follow the 4 standards: relevance, delivery, outcome, and sustainability. And domestically, for the shared facilities, the cost should be lower. For skills training, there will be more graduates in relevant jobs. For targeted support, there will be more R&D and innovation. And for one-stop administration, there will be faster and predictable approvals. Next page, please. Similarly, internationally, for the railway corridors and cross-border productions, we expect less delay and product damage, as well as technology transfer and stronger suppliers. So, therefore, we suggest an implementation of Policy A and Policy B as one package, since Policy A builds competitive green industries and Policy B connects them to Southeast Asian markets. So, considering Yunnan's existing industries and railway links, we expect the success of the likelihood high.
So moving on to the most anticipated part, the financial statement. Our finance model is actually composed of 4 parts. First, is removing friction actually worth it? We measure our data from shipment to shipment, and we have found significant reductions over the base unit of transport over here. Once the mandate reaches about 850K, we see that we will be able to transfer an amount of RMB 2 billion to stakeholders, some of them including farmers. Our second part is whether it returns. We measure a PV of 10 billion revenue against a cost about 4 billion RMB, which should give us about a return rate about 2.5. However, we do not blindly trust those, so we did a sensitivity analysis. In about 10,000 features, we are glad to find out that about 99% of them still breaks even. Even in our worst case scenario, as shown on here, we see that we lost a RMB about 1.7 billion. That is a huge amount, but still manageable and transparent. And then finally, about how we are asking. We are asking about a peak operation of about 2.5 billion RMB, and these will subsequently go through the process of these, and we will be managed to break even by 2032, maintaining a revenue of 500 million by 2038.
And moving on to the risk mitigations, we have identified 4 risks: the incentive risk, the international coordination risk, demand risk, and the financial risk. We base on the risk to create this risk matrix. However, they can be mitigated. For example, for the international coordinations, the government can improve the surveillance institutions to ensure more safety and efficiency. In the same time, for the demand risk, the probability to increase the price of products as well.
Your presentation time has ended. We will now move on to the Q&A session with our juries.
Hi, we anticipate your question. Thank you.
Thank you very much for the presentation. So my question is about, do you have any industry focus in this Yunnan Special Economic Zone? Because I don't think you disclose a lot of information about that. So as the second question is about the cost analysis. So your model is highly built upon a railway transportation through Kunming to the neighboring countries of China in Southeast Asia. So, as we know that probably transportation by sea is probably the most cheapest way. And have you considered this factor into your modeling? Thank you.
Yes, so to answer the first part of your question, there are actually three main sectors, three main industries that we are actually targeting. The first one is agriculture, the second one is biomedicine, and the third one is renewable energy. So based on our research, these are the three sectors that has the largest proportion and the highest potential growth rate in the future for Yunnan region.
On the second question, yes, we have indeed considered other alternatives instead of the current railroad, and we acknowledge that the unbuilding Vietnam to Bangkok railroad is one of our major blockers. It is not able to be complete on time. However, we think that our model is built on a simple principle of coordinating existing supply. So, according to our analysis, we find out that the current railroad, and including the high speed, is already sufficient for a huge amount of export and import inflows to transport. However, we found out that the current actual amount being transported does not match the capacity. We therefore seek to unlock the potential of existing building infrastructures without incurring any additional marginal cost, which we think is rather significant given the developmental features of such regions and the core of developing economic special zones.
And I think another reason why we don't choose to go through ocean is that you might also see the picture where we outline all the rail networks that is presently working. Actually, connected to Kunming, there are actually three main routes that is currently under construction or either actually working. So this is already done for our whole country. So it will make our export much more easier compared to sea routes, because there will be a huge potential with railways, and there is fixed plans already that there will be new lines in 2030, around 2030, connecting the southern part and also the eastern part.
I have a small add-on because for the medicine and biotics, it has small volume and a large value add-on benefits that is has already very low cost to transport and brings large revenues. So, and Yunnan is not close to the sea, so we don't necessarily consider transporting by sea, but instead by rail.
Yeah, thank you.
Can you elaborate further? How Yunnan will differentiate against other existing special economic zones, other than the logistic part?
We think the core of this question is actually captured by one of our expressions, saying that we do not want any existing mega infrastructures or like gigantic cities just appearing out of nowhere. Yunnan is special because it does not feature building another big city or a major product, but instead it features coordinating existing infrastructures and existing institutions together into something that actually works. We think that is actually truly unique because the developmental mode of China have always been focused on stuff like developing real estates, building these massive projects, but no one have actually figured out the frictions that actually operates in between the systems. So we think that that is actually one of the first programs that directly focus and tackles these problems.
Yeah, and adding on, we also differ from other products by we try to maximize the benefits and it increases the cost as much as we can. So a lot of the programs in China actually utilizes the China's own resources a lot, but in this, we actually engage in more international transactions and trying to use the Southeast Asia's their advantage in their economic growth to let China grow with them as well.
Thank you.
Okay, thank you for the presentation. And I was just wondering, Yunnan's GDP actually ranks at a very low level in China. So have you studied why this happened? And do you have, any targeted solution to that?
I think
aligned with your economic zone.
Okay, thank you. So maybe just give you an example. So say that Yunnan is actually producing a special type of medicine that only it has. But actually, the current situation that Yunnan has the resources, has a lot of technology related to the biomedicine field. They can produce good medicine. But however, all the stages that follows the production is lacking. So like packaging, like reselling, marketing, all of these strategies are done by other provinces like Zhejiang, Shanghai, other regions. So a lot of the value capture is away from Yunnan, not staying in Yunnan. So what we are doing with Policy 1 is directly targeting that point because we create one single value chain. By having more infrastructure that is shared among firms, they can have the whole consistent flow, the production line, from the basic raw material extraction to production, to packaging, to marketing, all in one, rather than scattering and delivering to other provinces and letting them profit.
We are actually deeply concerned with the well-being of Yunnan people. Yes, according to our knowledge, Yunnan is facing both a population decline and also a lower average GDP per capita across the country of China. However, I'd say that our project is the first step that we took away from the bubble economy that China typically characterized, is that we focus on unlocking the actual blockage, the frictions that locks away jobs, the frictions that turns away investors, and we build something actual. We think that once the frictions have unlocked, investors will surely come in because import now faces little friction. Like a simple medicine, traditional Chinese medicine from Yunnan could go easily to Vietnam, where like Vietnam-made products and tropical fruits go simply to Vietnam. That generates massive jobs, and we believe the economic gains we gain from there should also be fairly transported to the people of Yunnan, and then ultimately creating a significant advantage for the province. Thank you.
Regarding the more than 200 special economic zones that you said China has, so I just want to quickly start with, does Yunnan at the moment have any special economic zones? Or this would be the first proposal?
Special economic zones and also other economic development regions, we actually have a lot around China. Yes, Yunnan currently have something that is functions like an economic zone. They have a free trade zone. They also have a low tariff zone. They also have two other independent products like that. But we see that even though the CCP and the Chinese government is trying to establish those, we see that massive frictions still exist between these standards. Like even if there's a free trade zone in Yunnan, import tropical fruits coming to Yunnan still faces friction. That is why we think uniquely special economic zones in the context of China, People's Republic of China, functions at Yunnan because it coordinates resources from the local principle to the country level, and then we put them together and we truly unlock the frictions that blocks them at the municipal level.
Okay, but then let me just, because then you can elaborate. The logistics infrastructure is already there or being built. There are already special economic zones in Yunnan. So the one you are proposing, what is it going to add on top?
So just to clarify, there are several regions, particularly in Kunming and Dali. These places aren't just called special economic zones. They are more tariff-related and free trade related. So you can see Yunnan currently as Shenzhen decades ago. So Shenzhen once was a kind of like an economic zone, and then the government collected the whole region, the greater Bay Area around Shenzhen, and converted it into one special economic zone, and even greater. And it became one of the biggest exporting zones in the whole world. So Yunnan is currently functioning as a Shenzhen in the past few decades. And then now what we're doing is we are gathering everything around it, including the Southeast Asian trade, and all the nations around it, and collect it into one single unified.
So answering your question, what do we add on? No, we do not add on. We eradicate the barriers and the frictions surrounding these local economic regions by combining them into a large national level economic regions. And we hopefully, by pursuing such policies, we can truly unlock the potencies of these economic regions. Thank you.
Thank you.
Yes, we are Team CCP Consulting.
One road, one road, one path.
Thank you.
Thank you.
Before we invite the next group to the stage, we need a few minutes for a brief technical check. Thank you for your patience. We'll be right back on track. Patience. Now, let's welcome our next team, Team Canada, to the stage for preparation or technical check. You may begin your presentation now.
Thank you, members of the audience and the jury. Today, we'll be going through Canada's development case on its oil and gas industry and its energy sector, and showing you how putting 1 barrel in can produce a spectrum of value out through our project Prism. Now, it is clear to us that Canada's energy sector is broken. It is entirely reliant on one high potential yet low value exports purchased at a ridiculous premium from an international trade partner that flips tariffs, regulations, and rules on a dime. Of course, because of this, there are several different opportunities to be taken advantage of, and in doing so, we will implement both short-run consolidation and long-run implementation to produce a economic development strategy that improves on the existing special economic zone model used by countries around the world to bring high impact value numbers.
Now let's move on to the analysis. As we look at the per barrel economic, it shows that Canada is actively losing money over its oil exports. Canada is currently selling its oils for $88.6 per 1 barrel. However, it only takes them $89.46 to refine 1 barrel of oil at home. And we are buying for the same value of the good at $123.32, which gives us a surplus of $34 and a total concrete wedge of $1.1 to $1.3 billion per year.
Now moving on, Canada is currently entering an energy sector expansion cycle, especially under the Carney governance. We currently have active federal support, and all of this is to focus on one key issue, which is our over-reliance on the United States. Canada's exports in terms of crude oil, 90% of that goes to the United States. And the vast majority of our imports of refined oil is also from the United States. That means our biggest trade partner in terms of oil is the US. A partner who is extremely volatile, a partner who keeps implementing these damaging policies, and a partner who we simply cannot have this much reliance for. We also have Pacific market access, national corridor growth, and carbon infrastructure. Which leads us to our first key insight. Canada has shifted from debating pipelines to assembling a national energy corridor strategy. We are linking export diversification, domestic security, indigenous ownership, and carbon infrastructure.
We've also created 6 organizational framework of incentive alignment for different policies, and they are weighted on the current government policies passed and the government trends.
Now, based on these metrics that my teammate has just introduced, so we have a strategic options triage in which we weigh 4 potential options to decide which one we should really pursue. Option A leads on climate, B on national integration, and C on clean tech value add. However, option D, integrated prairie value add corridor, which combines refining, petrochemicals, and clean fuels, delivers the best balance of readiness, infrastructure, and market breadth. And this is exactly what we are looking for when looking for a place to develop an economic zone. For our second key insight, the strongest strategy is not the one that leads on a single objective, but the one that balances value creation, investor appeal, and near-term deliverability. Once again, exactly what option D hits on.
Now, introducing our solution, Prism, Prairie Refining Industry and Strategic Materials. As you can see, it is in a prism or triangular shape, for Fort McMurray, Edmonton, as well as Hardisty being our 3 nodes of production. Firstly, Fort McMurray being our primary production site, our Edmonton and IIH being our primary refining site, as well as having direct access towards the west and the Pacific, as well as Hardisty being our primary source of storage, as well as transition to the US and Eastern Canada. We're going to be basing this off with the 4 key partners. First of all, being Singapore with their already pre-existing strategy of intergovernmental councils. Secondly, Japan, where Alberta is already the 3rd largest export market and already having established agreements until 2035. Korea with already existing bilateral agreements, as well as Netherlands, as well as current existing plans which already have been created of technological advances in carbon capture. Right, so what are some of the benefits we bring then? Firstly, we'll have a one-window policy where the Prism Development Authority will coordinate all policies regarding this, making regulation extremely simple. Secondly, then plug-and-play infrastructure means that all these firms share the same infrastructure, which means that overall fixed costs are reduced. Thirdly, investment anchors. Current existing firms within the region anchors this down, which attracts new firms as there is already an existing supply chain within the region. Lastly, indigenous co-ownership, meaning that this plan is going to be way easier to develop and less delays. Overall, Prism turns Alberta's existing industrial base into a self-reinforcing cluster, where every new investment lowers the cost and strengthens the case for the next.
We have created 6 KPIs which can be tracked in 2040 and have classified them into 3 categories: economic value created, jobs, and industrial trade, and strategic resilience. We also have 3 phases, and they are each gated by committed demand. Phase 1 is anchor and retrofit, which is using the existing infrastructure towards more refineries. And phase 2 is convert, which is building more infrastructure for refineries. And phase 3 is export scale up, which is increasing our demand in oil.
Now, Prism is not just a gem in theory, but it survives the pressure cooker that is reality. Taking a look at our timeline, we can see that the time to act is now. Not only has Prime Minister Mark Carney recently secured a Liberal majority government, and not only has he already created a cross-partisan agreement with the Conservative Party that encompasses 90% of Parliament, but he has currently already, 2 weeks ago, placed a deal to increase pipeline expansion from Alberta to BC at a massive scale, and showing both the federal government and Indigenous groups' commitments and considerations for improving oil and gas infrastructure.
Now, beyond preparation, we'll also be securing buyers and private investors before we actually start building. Environmental reviews and permits will be completed before our final decision to ensure that the project is, first of all, commercially and also environmentally viable. Now, this final decision that takes place at the end of 2031 is a pivotal evaluation criterion point. And this is the time where we really do a cost-benefit analysis and really see if the project generates a net positive value given the 3 years of confirmation to our prior projections. Now, under the unlikely circumstance that it doesn't, we're able to mitigate further sunk costs and shift our strategy by leveraging infrastructure as well as the revenue gathered in phase 1 and use it for other domestic purposes. Now, the more likely outcome is that the project will actually generate a positive net present value. And so production will continue. So we will build shared infrastructure and private construction of privately financed refineries. And then by 2035, we'll be testing and opening our new refinery oil production.
Alright, now taking a look at our finances, we can see that by taking advantage of brownfield economics, Prism is able to by far clear industry peers. For example, look at its capex intensity, which is under half of its greenfield peers, and is absolutely dwarfed by the Sturgeon Investment Refinery project, which is entirely greenfield dependent. Now, also looking at the internal rate of return, we see that it is almost double the weighted average cost of capital that investors will be using for this project, and every single phase of the project hits the high end of the industry standard hurdle band. Now, we can see also that this project is protected in both 2 ledgers, private and public. For the private ledger, we see that from a private capex investment of around $15.2 billion, over 70% of that is kept by private investors. And in terms of public ledger, although there's a sizable tax investment at the beginning, there is a benefit cost ratio of over 2x.
Now, as with any other mega project, Prism also has its risks, and this includes financial overrun, demand decrease, policy arbitrage, social litigation, and its environmental implications. Now, to mitigate against these risks, we will have fixed pricing construction contracts, as well as modular building to control our costs. Then we'll also have purchasing agreements and a diversified customer base to ensure that we protect our revenue even under decreasing demand. Thirdly, we'll also have clawbacks to ensure that firms aren't capitalizing and misusing our subsidies. Then ownership agreements between environmental and indigenous rights will help with our social litigation. And finally, carbon capture towards the existing Alberta carbon trunk line will reduce emission as well as carbon costs. So together, these mitigations reduce our risks into the lower and medium range of the risk matrix. Energy,
If energy were Canada's necklace, Prism would be the diamond that makes it shine. Thank you very much.
Thank you for your presentation. We will now move on to the Q&A session with our juries.
Please also feel free to refer to our appendix in terms of any financial calculations that you guys might like to see or any data tracking.
Great. Your proposal focused exclusively on oil and gas energy, right? How about another key sector for Canada, which is the mining industry? How do you address that? Do you have any insights?
Yes, thank you. I can take that question. That's actually a really interesting question because the crux of this of our project is essentially the idea that of all of Canada's major exports, crude oil is by far the export that has the highest potential value add for Canada because we sell it at such a low differential. In fact, the WCS, the WTI differential, which essentially tracks the price in which more refined American crude products are able to be sold at a higher price than Canadian products, relatively speaking, is sitting at around $14 to $15 right now, which is an insane differential. And if we look at Appendix A, we can see that there is currently a potential of $20.4 billion to be earned from being able to have domestic self-refinery capabilities. Now, what that means is that this is simply the industry that our funds would be most appropriate to be invested in. And not to mention, there is also diversification in this because petroleum products, once refined from crude, could be then further refined into other hydrocarbons such as plastic products. So even in the case of a massive decrease in global oil demand, which we've modeled in our financial calculations, even then, Canada would still be able to use its current infrastructure and diversify into other avenues. Thank you for your question.
So thank you very much. So first, can you clarify your main objective is to resolve the issue of Canadians' gasoline dependency to the U.S., or you wanted to build Canada as a main gasoline exporter?
So our main objective is to reduce dependency of refined petroleum, especially with the U.S. We currently export a huge portion of our crude petroleum to the U.S. for refining, right? And what we want to do with this plan is reduce the dependency of the U.S. since they're an extremely unstable trade partner at this moment, and refine it ourselves, which, as my partner previously has said, will give us huge add-on benefits compared to the crude oil currently, which is being exported at very low cost but purchased back at extremely high cost.
Okay, so my follow-up question is, because the dependency to the U.S. is already a long-term issue for Canada, I think for years, right? So have you considered the economic comparison between the refinery you proposed built in Canada and the existing refinery facilities in the States? So why? What is the situation, the comparison, and why do you think your proposal will, narrow the gap of this kind of cost analysis?
Yeah, sure, absolutely. So, technically speaking, the status quo that we are living in right now is exactly that scenario you described, in which Canada is entirely, and I mean entirely, dependent on the US for refining its crude oil products, which then it either is no longer able to sell to its own partners and is not able to take advantage of its own free trade agreements with other countries, such as the ones in Asia we mentioned, nor is it able to actually produce its own liquefied petroleum products for its own domestic consumers, which, like we mentioned, requires buying back from the US at an exorbitant premium, right? So that is the status quo we're dealing right now. What that means is that every single financial projection we calculate, whether it's IRR, NPV, or any other value, is based on improving from that status quo. So the status quo can be assumed to be exactly a financial net zero world we live in right now, and net zero in reality is by far net negative for Canada because there is this much potential to be gained from this industry, as I've demonstrated to you. Thank you.
So I have a question just to discuss with you guys. Right? There's something called multi-market competition, meaning that if there's heavy reliance of, in terms of gasoline, petroleum on the U.S., Now you're saying I could form alliances to actually break away from this heavy reliance. Would you not worry about cross-market retaliation from the big brother?
Actually, yeah. So one of the most important things we did in terms of financial modeling for our model is actually considering the trade war scenario exactly as you described. Now, if we go into our appendix and we take a look at the modeling that we've done for this, right? Because we've done more than just regular sensitivity model with just some percentage change. We actually fully modeled a trade war scenario. Sorry. Keep moving. Right, so as you can see here, we essentially did a 3-scenario distribution right here, and like you described, the scenario in which the US retaliates with, let's say, tariffs on other products is exactly the trade war redux that's demonstrated here. One of the most interesting things we projected is that this is actually a net positive scenario for Canada, because by essentially removing that precedent of the US being our, essentially, like you said, our big brother, right? And essentially forcing private investments, which, like we've shown in our financials, has an incredible private to public ratio in terms of our investment capabilities. It essentially forces the hand of these companies to invest in a decision that is net positive and is a tremendous amount of gain for them anyways. As we see right now from our modeling, the issue never was that there wasn't financial gain to be gained with. Of course there was. The issue was just simply that the legislation of Canada did not allow at the time, let's say 5-10 years ago, to enact this project. Now that the Carney government has already promised to have such monumental changes in its oil and gas infrastructure, combined with the events of the world going on right now, this is the precedent to push these investors forward. And like you see, this is the result of it. Do we have any more questions from the jury, please?
Okay. I want to maybe invite you guys to deepen a little bit the consideration of the bilateral relationship. So, if I'm not mistaken, you wouldn't be the cheapest option for the US to buy crude oil, but because they want to reduce the reliance on Middle East oil, then Canada became a closer partner. I'm assuming that there must be a reason, or I want to understand, did you explore why is it that Canada hasn't previously tried to refine their own oil products to sell to the US? Is there some kind of agreement in place that actually says that the US is entitled to buy from you crude and then refine, and you guys have to buy it back? Is it some kind of agreement? I just want to understand if there's any legal backing or if you look into that.
Okay, yeah, thank you for your question. So the main reason as to why Canada hasn't really had as many oil refineries as the United States and why we've been purchasing so much refined oil from the United States is simply because, first of all, prior to the Carney governance, we never really had any flow as to new projects related to oil. So there hasn't been a lot of pipelines, and because there hasn't been a lot of pipelines, companies within Canada has always thought that it would be better to just keep existing trade routes going through the United States and coming back to Canada, which is what the status quo has always been. Now, once again, because of Mark Carney, even 2 weeks ago, he has backed a project creating a pipeline from Alberta all the way to Burnaby, BC. Due to these recent incentives, we believe that this is actually feasible and that more and more people will invest in this, whereas before they wouldn't have.
Since we still have time, feel free to, you have a lot of appendices. Could you guide us through how did you calculate the additional investment to build up the refineries versus the excess that you can gain from it?
Yeah, absolutely. So, you're talking about primarily the capex, right? and capex relative to revenue, let's say. So for instance, this would be our gross revenue calculations, as we've already talked about. It is an absurd amount of potential return left on the table. Then if we move forward a little bit, right, so we could see, for example, one of the most important questions we might ask here is why would capital come now of all times, right? We see that, just taking an example of Prism's Phase 2 development project, which is primarily the oil refineries, it is at such a discount relative to so many other developments, not only in Canada, as we see from Sturgeon, right, which was technologically a success, but financially considered a failure, but also around the world.
Thank you very much for your Q&A session, and you may now return to your seats. Our jurors may now proceed with your scoring. Now, let's welcome our next team, Team Ecuador, to the stage for preparation and technical check. You may now begin your presentation.
Hello everyone, we are Team Ecuador, and today we are going to present the project of building an industrial park in our country. So Ecuador has a GDP of 130.32 billion US dollars. Of that GDP, a big part is made up of exports, being 31.56 billion US dollars. As we can see in the graph, most of that is made up by oils and fishing. To take advantage of that, we thought of making a recycling center that can use waste redirection in one of Ecuador's biggest markets, the fish market. Now, this would create job opportunities for local people, as well as improve the Ecuadorian waste management and the local environmental protection. The biggest stakeholder in our project would be the Ecuadorian and the Manabi, and in the case Manta government, who would be able to increase societal welfare for poor regions, increase the economy of some of the most important coastal cities, and increase infrastructure, as well as companies who want to be a part of the industrial park, and the people who have to work there, and those who want to invest in it.
Initially, we were considering two potential locations for our industrial park. The first of which is a small coastal city called Pasorca. Pasorca has the advantage of being a tax haven, as well as having the only deep water port in all of Ecuador. However, that port is owned by a private firm called DP World Limited. Secondly, we have Manta. Manta is one of the largest cities in Ecuador and thus has a large available workforce for our project, as well as having one of the largest fishing ports in Ecuador. This port specifically handles upwards of 600,000 tons of fish yearly. However, some cons of Manta include that foreign investment is not nearly as incentivized as it is in Pasorca, as well as it is a pre-established fishing city. The decision that we ultimately arrived to was choosing Manta, specifically because Pasorca, having that its port is privately owned, the government's profits would be diminished with its investment. And furthermore, Manta, given that it's a well-established city already, would offer more resources and the infrastructure necessary to construct our project. And in the fishing industry, roughly 30 to 45% of total fish waste is wasted in processing. Because of that statistic, we created the idea for waste recycling plants, specifically in Manta. Waste recycling plant has the idea of recycling fish waste and turning it into a product that the government can actually sell, such as fish oil and fish meal. This kills two birds with one stone by paying back the factory's initial investment, as well as promoting sustainability, as well as protecting the local environment. There are three main policies which are integral to our project. The first of which is organic
organic law on inclusive circular economy. In this piece of legislation, there is a policy extended producer responsibility, which essentially means that firms are obligated to fund for the collection of their waste that they produce, in this case fish waste, so this legally secures our input for the factories. Second of which is organic law for the development of agricultural and fishery, and this essentially requires that the government encourages and creates incentives that promote the sustainable use of fishery resources, which is the aim of this factory. And third, Article 415, which directs and states that the state creates incentives for renewable energy, clean technology, which is again the aim of this facility.
Now, as for the economic benefits that we will receive from this project, first of all, the product revenue. So, by producing fish meal and fish oil, as mentioned earlier in our factory, we'll be able to get a revenue off of what we have. And fish meal and fish oil is a market that's rapidly growing, especially in Latin American markets, and is predicted to reach a value of up to $14.55 billion until 2029. That means that we can have increasing revenues in our project while it's lasting and reach a much bigger market. Also, we're going to be fixing a current negative externality. A study in Los Esteros, a neighborhood in Manta, revealed that 35.8% of households suffered from pollution from a local tuna processing plant. If we build a recycling center, we can mitigate those losses and have less of that negative externality. And also, we will have an import substitution. At the moment, as I mentioned, Ecuador has a very big fishing industry. And fishing needs fish meal and fish oil. But if we're able to produce that locally, that means that we can get an advantage on our trade circuits. Now, as for the economic process that we will have, first of all, this process is very energy and water intensive. There are two things that historically Ecuador has lacked. In 2024, we had nationwide blackouts, which proved how energy may be an issue. And furthermore, it's reliant on the fish supply. So we may have months where we don't have as much fish supply, and we're not able to get as much revenue, leading to problems paying workers or paying for our costs. Now, as for the variables, for financial analysis, we ran two projections. One pessimistic and the other optimistic. The variables that we use for the optimistic projection are fish export of 600,000 tons per year, as well as 5%, 45%. The oil yield to be 12% and the protein yield to be 25%. A price of oil estimated at $2,900 per ton, as well as a price of protein at $2,000. An average annual wage in Ecuador per worker of $8,400 and an operating profit margin of 18%. Because we don't expect the factory to start at full capacity, we have a revenue ramp in the first year of 55%, in the second of 85%, and from the third year onward at full capacity. And finally, we assume 1%.
Okay, so in the optimistic scenario, we expect to capture up to 18 different investors with a 32% total market capture rate. We also have certain fixed costs, such as land and environmental costs that we derive from the regional area. And finally, we have the division between public and private investment, totaling 189 million. So to derive a net present value, and more importantly, what percentage of the market we must capture, we first derive the feedstock, which is the percentage of fish waste that we can capture. Then we also see how many tons of oil and protein we can derive respectively. Multiplying those by their market prices per ton gives us a revenue, and finally our profit is found by multiplying with the 18% profit margin. We also have certain fixed costs such as the wages, the land fee, and the environmental costs, as well as ramping up cash flows from year 1 to year 3. We derive this to find this equation. We see that it intercepts the y-intercept at 0.23, which means that on an optimistic scenario, we must capture 23% of the market to break even. We ran a Monte Carlo simulation of over 10,000 trials to find what percentage of times this will actually happen, and we found that we only break even or make profit 12.5% of the time. Things don't get better, however, because if we stick to the pessimistic scenario, we see that we must capture up to 89% of the market, which would be considered a monopoly and unfeasible. The Monte Carlo simulation backed this up by finding that we succeed 0.0% of the time.
Now, seeing that this will not be feasible at all financially, we decided to split the project into two phases. A first phase, where basically we do the same idea but on scale. Instead of trying to get so many tenants and trying to expand so much, we try it with a smaller market with an investment of around $20 million. Once this begins to make profit, we can switch to the second phase. And the second phase is the same as we mentioned earlier, with an investment of around $150 million US.
Since the phase 1 plan is much smaller scale, we only expect to capture up to 3 tenants and 12% of the market. We still see the fixed costs and the public and private investment spread, however, we see that it's only 1/10 of the initial cost. The NPV formula stays the same, however, it's pretty important to now note that we only discount for 10 years. This shows us that we must only capture 5% of the market in a smaller scale project, and the Monte Carlo simulation shows that we actually win 36% of the time. However, the pessimistic scenario actually shows that we must capture 14% and we only win 0.2% of the time. Obviously, this comes with risks such as financial, operational, market. Phase 1 will completely invalidate the financial risks because if there is a loss, we will incur a much smaller one. Also, the operational risk will be countered by making a reverse action and letting firms choose their own entry price. And finally, since we are running 2 different revenue streams, market risk is mitigated.
Now, the recommendation that we have for the Ecuadorian government is to advance with the first phase immediately, as this is cheap, and even if it does not work, the economic benefit that it brings will be greater than the financial cost. Once this begins operating profit, you should advance to a second one, because this proves that the market is feasible to invest in this. The impact that we have is shown on this chart, and that is all. Thank you. We are open to all questions.
Thank you for your presentation. We will now move on to the Q&A session with our juries.
So thank you very much. So can you describe the world's fish processing industry, the current situation, and why you think your project is competitive?
Just correct me if I'm wrong, the current situation of the market, right?
The fish processing, right?
Yeah. So when fish gets processed in Manta, and we are using a very conservative estimate here because it's actually 600,000 tons of tuna, so the actual fish that is exported, so the actual fish that stays is not counted towards that. And what basically happens is that you lose 40 to 30% of the fish after you process it for meat consumption. That is the head, the cartilage, the bones, and all of that is then mostly thrown to waste. Manta does have a small ecosystem to recycle this waste. However, it is not a big market, and firms do have their own form of disposal. However, we are enabling an even cheaper form of disposal helped by the government. This is very feasible because it's a market that is pretty much non-existent and non-competitive yet, due to the fact that there are so many firms competing in the Manta environment that they haven't yet to collude into a single and profitable stream to recycle fish waste.
I think my question is more about, as compared to other markets, we know that there are also other countries or areas that we also do this kind of a fish processing business. So I wanted the comparison of your project and the other area. So basically the competitive analysis of worldwide in the market, for this niche industry.
Well, we didn't do much research on other facilities, but for example, in the picture, in the slide of our factory, there's a picture of a similar facility in Norway, but when we were doing research of these types of facilities, we did not immediately see any in, obviously not in Ecuador, but not many in South America, as this is one of the only pictures that I found of related facilities. And of course, given that Manta is such a large hub for fishing, as we said, 600,000 tons annually are handled in Manta. Having a facility of that size, that type of facility in such close proximity to the entire industry there is definitely a comparative advantage in distance.
And specifically for the two products that we are selling currently, it is important to also take into account that Ecuador is the leading exporter specifically on shrimp, and there are small and very non-profitable factories in the rest of South America, and since this is one of the biggest ports that we have, this is not a project that is being underdone by any major facilities on outside cities. We're also importing a pretty big percentage of our fish oil as well as protein feed for animals. If I'm not wrong, it's about 70%, and we can, by producing that at home, we can also benefit the local ecosystem.
converting fish waste into fish oil and fish protein, I think it's a great idea because you're adding value, right? But have you thought about extend it further by creating a consumer brand out of it? Because at the end of the day, fish oil is still a commodity. Maybe you can capture more value by creating a branded consumer goods.
Well, as far as I know, fish oil and fish meal or fish protein are generally things that are used in the fishing industry in order to take care of the current fish, like so that they can for fish farms, right? So creating a consumer brand out of fish protein is almost impossible. It's not a protein that can be made into, for example, a whey protein or something like that. However, it would be possible for fish oil to use that fish oil and sell it towards another market. We have not considered that possibility. However, I think if we did, it would be possible to increase our revenue. But as I mentioned, Ecuador does need it for its own fishing capabilities. So I'm not sure if it would be the most efficient solution.
Also, to that question, Ecuador does have state-owned enterprises because it is somewhat more of a socialist political form of ideology. But having a state industry specifically in fish oil and fish meal, I think logistically for a country with such little resources like Ecuador would just be like logistically sort of unfeasible and unnecessary.
Right, thank you very much for the presentation. My question is, to identify the mentor in the national situation, can you give us a profile in terms of the weight in GDP? And then if you conduct this project, how it's going to quantitatively improve the region and at the national level?
Right, so Manta is located in the Manabí province. It's a province more or less in the southwest of Ecuador, and it's a city that has a population around 300,000. I believe that the GDP of Manta is near $2 billion, most of it brought through portuary activities, which, as we mentioned, handle about, I believe, 900,000 TEUs yearly. But I might be wrong on that. Furthermore, Manta is one of the biggest ports in Ecuador. However, it is not the biggest port in Ecuador. We do have bigger ports, like the one mentioned earlier, Port Saja, and the port of Guayaquil. Those two are the most important ports that Ecuador currently has and are usually used for export to international markets. Now, the main thing that Manta has, which makes it a better site than the other places, is not only its moldyability, because even though it is a decently large city for Ecuadorian standards, placed at 300,000 people, it's a city that has a lot of empty space. And also, so we have places to build. But the other thing that has a lot of processing. Most of the fish that passes through Manta isn't directly going to the port, but rather is being handled in Manta. As I mentioned, there's things such as tuna processing plants and etc. So yeah, that's essentially
piggybacking a little bit off that. Also, Ecuador is in a very big GDP to debt ratio for the size of the nation, around 70%. This is the main thing that is stopping us from undergoing any larger project and going into big debt. The total debt that we would undergo would be 150 million. It wouldn't be that much compared to the actual debt that Ecuador currently has. However, Ecuador is already subsidizing a lot of materials such as gasoline, which makes the government run at a constant fiscal loss. So undergoing any more debt in that sense would not allow us to truly go a big project. And this is why we are also trying to outsource some farms by outside investors.
Okay, thanks. And second question is, you propose two possibilities, right? And then is that what you explained just now? Actually, the rationale by choosing one among these two. I mean, could there be any possibility, in terms of selecting one whilst collaborating with others and to make it like economies of scale? This kind of possibility.
I can't really hear back from you, but you said there's a possibility of selecting wrong?
No, yeah, you choose one between the two, among the two, right? Would there be a possibility of identify multiple sides to work together and coordinate together to make it economies scale?
Yeah, the thing is that we do have two sites, which is Pozorca and Manta, but specifically this project is only tailored for Manta because Pozorca already has a lot of outside investments. However, it is constantly improving its capacity, and any more government intervention is not needed. It has over $1 billion in private investment, and the amount of money that the government can actually put into that port is not as big. Also, Pozorca is not a fishing port, it's simply an export port, and while it does handle a lot more cargo, it does not process any fish right there.
Also important to be considered is that the port of Pozorca is completely owned by DP World Limited and is a tax-free zone for the first 5 years that we're in, and they haven't been here for 5 years yet, meaning that the government has nothing to gain from working with Pozorca at the moment. However, the other limiting factor is the infrastructure in Ecuador. Even though we have roads, the roads aren't adequate for transport of like semis, for example, a lot of transport between the two ports, and the infrastructure will make it more difficult to collaborate between the two. Maybe in the near future, when the tax-free is done and infrastructure may be improved, then it will be possible to collaborate.
Just want to say, last 20 seconds, I do appreciate all the maths there. So the multi-color simulation, I think you guys have done a good job.
Thank you.
Thank you. You may return to your seats. Our juries may now proceed with your scoring. Now, let's welcome our next team, Team Hong Kong China, to the stage for preparation and technical checks. You may now begin your presentation.
Good morning, we're Team Hong Kong, and today we're proud to present the Jiangmen Economic Zone upgrade. Now swiftly moving on to the executive summary. So our policy recommendation is not to build a new economic zone and instead upgrade an existing one. So this is why. China is already saturated with many economic zones, and specifically we will upgrade the Jiangmen Daguangbei Economic Development Zone through administrative upgrades and land policy reform. Now there are two clear benefits to this. This builds into the government's Greater Bay Area strategy, and it also aligns with China's major objectives as outlined in the 15th five-year plan. Now, according to our policy recommendations, here are some financial and fiscal benefits with positive NPVs and positive benefits for jobs and annual tax remittances later.
So now we are going to answer a crucial question. What is an economic development zone in China? It actually isn't a single type of zone, but rather an established administrative framework. So under this framework, regional governments cannot just build a new economic development zone just based on their imagination. They have to comply with the existing framework. Under this framework, there are three major types of economic development zones. The first two types could be national or provincial, and they account for over 90% of the existing zones altogether. The third type, special economic zone, while it's well known, it was unfortunately a historical product of last century's opening up reform and opening up period, which the government is unlikely to add. And for each economic development zone, it could be equipped with custom special supervision zones to facilitate imports and exports, as well as strategic overlay zones to ensure the coverage of special preferential policies. So China is currently saturated with economic development zones. Across the whole nation, we have over 2,200 economic development zones. So on average, that's 6.6 zones per prefecture city. And this overcapacity has led to a high vacancy rate hovering around 30% to 50% for many industrial parks in the economic development zones in many cities. And currently, building new zones is strongly against the policy intention of the central government. According to number 7 order issued by the State Council Office in 2017, it mandated mandatory integration and optimization of existing zones.
In this case, upgrading is clearly better.
Like for building a new zone, for example, the demand is saturated, and we also have to face higher empty zone risk. However, on the other hand, if we choose to upgrade, we are facing a strong growth potential, and we are taking the advantage of established industry and infrastructure. Moreover, we are matching the Chinese government's 15th five-year plan, quality over quantity. So our problem isn't to fill zone. What we need to do is to increase the productivity of the existing one. Upgrading is certainly the right track. And then, moving on, why we choose Xiamen from thousands of the industrial parks and economic zones in China? Firstly, to maximize effectiveness, we searched for several economic clusters backed by the 15th five-year plan. And then, considering the goals of the five-year plan and the situation of Greater Bay Area, we pick it and its underdeveloped Western Bank. And finally, the land, coast, energy, and connectivity are the reason why Xiamen stand out.
But let's take a step back, because before deciding a location, we asked what kind of government objectives we want to follow. And looking at China's five-year plan, we found that technological self-reliance, low carbon production, as well as greater regional coordination are among the priorities. And Xiamen fits that niche really, really perfectly, because it has that advanced manufacturing capacity and it has those renewable energy sources. But we have to also talk about the Greater Bay Area, because it's an economic engine of around 15 trillion renminbi. But the issue is that it's slowing down, and firms on the Eastern Bank, including Shenzhen, face scarcity and higher land costs. Now, the issue with that is that a lot of the eastern coast, a lot of firms are moving away from it. So the West Bank can effectively grow the GBA without forcing firms out. And that's the key point here. The GBA needs more room, and Xiamen can create that room without, forcing the firms to sacrifice their finance, their supply chains, and their technology. So Xiamen also has a very unique quadruple advantage, because it has the greatest area in the GBA, and it has around 3,000 square kilometers of undeveloped land. It has lots of coastline, and you can build deep seaports here. You have clean energy sources from nuclear and wind sources, and you also have infrastructure that's improved its connectivity.
Also, Xiamen is not an empty zone. It has a very strong industrial base, which creates a very ideal condition for upgrading. This can be proven by the following data. With firstly, it covers 43.1% of the entire manufacturing share in this area, and also last year more than 15% of the annual output growth. And in total, there's more than 1,800 of the high-tech enterprises, which create a very large opportunities. Now let's look at some of the examples of the companies over here. For the CALB, it is already having the 20 billion of the battery plant. At the same time, the laundry is also having 18 billion RMB of the annual output. It is also worth mentioning that the JNS is the first builder in the entire world of the handy-size of the boat carriers. And according to the graph, one can see that over the last 3 years, the output of the battery sector has almost tripled. Next slide, please. Now, Xiamen is also having the advantages, transportation, infrastructure. Over years, the establishment of the several links has efficiently made the transportation cost to be smaller and the duration to be shorter.
Now, moving on to our policy recommendations. We recommend an institutional upgrade to Jiangmen Economic Zone. And by that, we mean upgrading the Jiangmen Dagongbei from a provincial level to a national level economic zone with an integrated comprehensive bonded zone. Now, that's a lot of lingo, so let's break it down. So for national economic zones, there are preferential tax rates, so 15% corporate income tax, 15% individual income tax. And for the second one, comprehensive bonded zones, there's 0% duty-free imports, 0% VAT, and of course, 24-hour cargo clearance targets with expedited customs. So that is very useful for very export and import-oriented industries, and there are also foreign direct investment liberalization with negative list management for both of these policies.
So now we come to policy 2, where we sell firms to invest factories, standard land instead of raw land. So standard land refers to land covered with semi-utilities and graded land. So this addresses a central limitation, the long factory lead time. It reduces the lead time by around a year. And our measure involves 3 additional benefits or components. The first one, exemption from assessment. So when the government converts raw land from standard land, it can conduct safety and environmental assessments in large batches, so that for firms they no longer have to conduct such assessments by themselves, which saves up to 60 days in terms of the lead time. And secondly, our rent first, then buy policy, which significantly reduces the upfront outlay in order to attract businesses to Jiangmen as a kickstarter of the industrial network effect. And finally, our clearing out policy. So starting from the 3rd year of operation, firms with an annual taxation of 120,000 yuan per year, if the taxation is below this number, they would be cleared out.
Okay, so moving on to our financial analysis, we built a Monte Carlo simulation for evaluating the national economic zone and the comprehensive bonded zone. As you can see from the graph, the median NPV for a 15-year horizon is around 210 million RMB with roughly a 1% chance of loss rate. So there's one assumption about this, and this is only a financial model for the operating Jiangmen authority. So this does not account for the fiscal benefits, the employment benefits, the regional economic benefits that we'll cover on the very next slide. Now, we also made a Monte Carlo simulation for land policies. So as you can see, most of it is positive NPV, but there's a roughly 21% loss chance that we have a mitigation strategy that we can talk about later in the Q&A session. So there are also many fiscal benefits to the 2 policies. So there's direct fiscal revenue, employment impact, land value appreciation, and of course in the long run, we want to rebalance the GDP. We want to make the economic development more equal across the bay.
Finally, we also make a risk matrix for our further evaluation of our project, which including the competition risks, land oversupply, construction cost overrun, and execution risk. And among them, the most important one is the execution risk, which is the most probable and most impactful. And our strategy is to claw back all the economic incentives. And if the revenue targets is mismatched by our targets. Thank you.
Okay, so in conclusion, our policy is to upgrade Jiangmen, not create a new economic zone. It is a very great Greater Bay Area opportunity. It's at the right place at the right time.
Thank you for your presentation.
Thank you. We welcome your questions.
Thank you. We will now move on to the Q&A session with our juries.
Okay, thank you for your presentation. So I was wondering from your identification of Jiangmen, so what is the driving engine to boost the economic performance? Is it on the supply side or the consumer side?
Yeah, so basically why we started with Jiangmen is, again, we looked at the major objectives of the Chinese government, but let's just focus on the Greater Bay Area first. So a macro analysis of the Greater Bay Area, there's a lot of the land prices in the eastern part of the Greater Bay Area right now are extremely expensive. So many companies, they're looking for alternatives that access this area, that access the many companies, the many very great companies that exist here, but also be able to afford that. So Jiangmen, being positioned as a peripheral city to the Greater Bay Area, it is a great place to start economic development. And we also stated there are very many strategic advantages to Jiangmen. So for example, the increased connectivity in the recent years with the passing of the bridges. There are deep sea ports that can be established and sufficient green energy offshore wind farms that can also be developed here. So we believe that this combination of factors and the need to expand the Greater Bay Area can be effective to make Jiangmen our primary choice.
To add it as a supplement, we believe that in Jiangmen area, not only including the green energy benefit, the land cost, we can also have the strong industrial monetary base, which comparing to the new exploring zone, the greenfield areas, it has already have the foundation which can attract labor and capitals. That means the startup cost of having the innovation and the economic revolution in Jiangmen is relatively smaller than the areas of new areas. And of course, as Chairman has said that, comparing to prosperous areas, land cost is relatively cheaper. So the cost efficiency as the major priority of our project is better comparing to other cities.
Thank you for your question. I would also like to add a short point to this. Jiangmen offers flexibility for firms because they also have lower costs. So industries from Shenzhen, if they need lower costs, especially startups, they can move it. But it's not meant to act as a substitute. It's meant to act as a complement. Because Jiangmen itself, it also has a lot of industries like electrical circuits. They make large-scale boat manufacturing. They have, they make large-scale boat manufacturing, green energy, and batteries. So it's not meant to replace existing industries, but it also gives flexibility.
I actually, a follow-up question. So you mentioned that there's, it's going to accept the spillover effects from the Great Bay Area, but then the Great Bay Area also, the whole economic development is slowing down, and I was just wondering, there can be systematic or very, sort of deeper reasons. And then it's not just, because of the cost is going high. So whether you have, thought about that, and how would you address that?
Yeah. So while indeed the Greater Bay Area might be slowing down in the shorter run, we should also keep in mind the national policies. So in the short run, I agree with you. In the long run, we need to consider the national policies as mentioned by the 15th Five-Year Plan. So what the Chinese government is saying is basically the Greater Bay Area it also needs to expand. So basically what we want to do with Jiangmen is to build on this existing national policy and make it effective.
Can you walk us through the financial analysis beyond the Monte Carlo charts?
Okay. Can I clarify? So what part of the financial indicators would you like me to clarify? Because
how do you come up with this?
Yeah. Okay. So for this Monte Carlo simulation, this is for policy 1. It is for promoting the zone from a provincial to a national level. So let's just run through this chart real quick. One of the reasons why it has quite a low loss probability is because of the low costs usually associated with promoting a provincial up to a national. So there aren't really many costs here. So there are application process costs, there are compliance costs. Now, in the long run, there are many revenue streams that could stem from this development. So, for example, there's central fiscal allocation, provincial matching. So all of these. So for these numbers, we took reference numbers from a bunch of other regions in China, which also experienced this provincial to national change. And then we added a roughly 30% plus and minus using a triangular distribution model to make sure that the probability of each one of these revenue and costs are accounted for.
One of the things I believe you mentioned is that you wanted to move away from promoting raw lands and you wanted to standardize land, and so there was already a bunch, I think it was like a package of 9 things that you wanted to provide, so there is an upcost to that, right? So we promote land that you have to invest in upgrading infrastructure, even if it's just for some basic things like you were saying, the power, connectivity, and so if you consider only application process compliance costs, do you think that maybe the simulation is a bit optimistic? That it's not that cheap?
Yeah, so this Monte Carlo analysis is just for our first policy. Let's go to the next slide, please. So this is the Monte Carlo analysis for our land policies. So let me just elaborate on what we missed just now. So there's around a 21% chance of a loss here, and that is mostly due to land absorption costs. So that basically means that when you build land, when you develop land, this land isn't really utilized to the maximum extent. So our policy here is if the pilot fails, losses are contained to less than 500 million of the NPV. So what this means is we want to cap the initial spending period, we want to cap the initial pilot to roughly this amount. So to make sure that this plan actually works.
And at the same time, so for our policy to the conversion of raw land to standard land, the first pilot program only involves 1 km square of land, and it only takes 1 year for the conversion process to complete. So after 1 year, if there's no firm
willing to claim that land will immediately be dedicated to our policy one, which is the construction of the comprehensive bonded zone. So, even if there may not be there may not initially be firms willing to enroll into the Policy 2 program, our initial investment will not be a sunk cost. It will directly contribute to our investment in Policy 1.
So just wondering, right? So the Greater Bay Area is very well known, right? Multiple cities across the coastline, right? Including Shenzhen, Hong Kong, Macau, and so on. So compared to these larger cities, Jiangmen is definitely one of the smaller ones and weaker link on the west coast, like you mentioned. So would you consider there potentially, possibly more bureaucracy, from the local government that maybe, not necessarily help with fostering, economic zone development?
Okay, so the approach when we took to these economic zones is we first evaluated them on a national level. So China is famous for centralized planning. So while there might be bureaucracy, we do believe that the existing economic conditions of the Greater Bay Area could induce investment. And because the national policy already explicitly says that this area needs more development, we believe that these bureaucratic procedures might be eliminated in the long run.
So one more question about Jiangmen then. So Jiangmen had a policy to actually attract businesses to come in, right? But then there's also sort of policy that's sort of stopping the government from sort of giving tax benefits, right? So would that be an issue, in terms of attracting businesses from bigger cities like Shenzhen or Hong Kong to come to Jiangmen? So what would be some of the tactics you guys could use to attract businesses to come into Jiangmen?
Yeah, so the goal in general, we're not trying to target the best of the best. Because these industries, they are usually quite developed in Shenzhen already. So there's not much, let's just say there's not much point for them to perhaps further expand to these places. However, what Jiangmen intends to attract are low to medium level sized companies which may find Shenzhen and this entire Greater Bay Area as too costly and provide an alternative for them. So through this, we do believe that we are able to attract maybe smaller sized companies, albeit high tech.
Thank you. You may return to your seats. Our groups may now proceed with this forward. Now, let's welcome our next team, Team Brazil, to the stage for preparation and technical check. You may now begin your presentation.
Members of the jury, other observers, welcome. We are Team Brazil, and today we are going to propose our rare earths-oriented economic development zone in Brazil. Next slide, please. So, in sum, the characteristics of Brazil lead us to observe a unique opportunity in rare earths. And, however, there is a lack of know-how and high starting costs that mean that Brazilian firms have not tapped into the potential of the rare earths opportunity in Brazil. So our proposal is exactly to create an economic development zone with incentives that bring foreign investment into this zone for rare earths processes development. We are backed by our financial analysis with payback by 2042 and a 15.8% IRR, and we also have appropriate mitigations for the risks that we consider. Next slide, please. So, the first question that should come to our minds is why Brazil? Which structural factors can be leveraged to create an economic development zone? A zone that, by definition, needs to bring foreign investment to develop locally. We have three main factors. Firstly, the resource abundance, especially in minerals. Secondly, the clean and cheap energy that we supply. And thirdly, the neutrality in geopolitical matters, being Brazil one of the most prominent neutral countries in the world. These three factors lead us to rare earths. Next slide.
Rare earths possess exclusive properties that no other material can enable. For example, the development of permanent magnets for EVs, electric vehicles, and highly efficient cooling for AI development. Industries that are dependent on rare earth minerals represents more than $5 trillion in the world, and AI alone is growing at a 26% year-over-year pace. So this is a massive, highly important industry worldwide. So now we should explore what this industry specifically needs. It needs three key points: cheap energy, minerals that are easy to explore, and stable institutions for long-term profitability. And Brazil possesses all these three key features. Next one. So now arises a very important question: why hasn't it developed yet? Because most of the value is at the top of the chain, while the top of the chain also has the largest barriers to entry. We estimate that the chain goes from extraction to leaching and cracking to the production of oxides to then metals to finally the production of magnets. And Brazil only operates in the lowest value, that is extraction, because the further ones need high capital that Brazil does not have, and know-how that Brazil also does not have, that's concentrated outside of Brazil. We estimate that more than $3.5 billion are left on the table because of this underdevelopment of the country. To resolve this potential, what we propose? A massive coordinated proposal from the government. Firms, because later stages are dependent on the stages that come before, for example, oxide transformation is dependent on leaching, independent companies do not have an incentive to be the first to invest. They need someone to coordinate. And this creates an economic rationale to the government to enter on these later steps of processing in order to coordinate private capital and create an efficient and real rare earth minerals industry in Brazil. Next slide.
Now, to understand where we should start this economic special zone, what we need to analyze are three main criteria. The first one is geographical, the second one is energetical, and the third one is about some similarities. About the first topic is already being achieved because almost all the extraction points are really near Bahia, and not just that. If you analyze the north extraction points, what happens is they are connected to Bahia because of the north-south rails that we have. And actually, it ends on the coast of Bahia, that is where we have the hugest ports from Brazil, guaranteeing a huge outflow of products. Not just that, about the energetical, Bahia is the biggest producer of energy in Brazil with the cheapest energy. And thirdly, in the third filter that we applied, Bahia we have the hugest BYD industry in the whole world outside China that guarantees not just about know-how but also guarantees an internal demand that also needs these rare earths. Next slide, please.
Our thesis is based on two projects from China that actually worked out. First, we have Guangdong, which is a project of industrial development in China across borders, and second is Butong, which is the only economic area just for rare earths. They also do a lot of R&D and research in partnership with university. So what Bahia should do is learn the key points from both of these major areas and do investments, R&D, and also partnerships with other universities. Next slide, please.
Now, with that in mind, how can we design our own system to replicate the success? Now, we have constructed a series of fiscal policies that will help the region develop. Firstly, construction finance, so that firms can overcome the high cost that is to enter the rare earths processing segment. Secondly, the production subsidy, so that they can maintain throughout the existence of the zone, they can maintain low operational costs. And thirdly, a regressive subsidy system, so that we can incentivize firms to go up in the value chain of rare earths.
The key takeaway here is progressivity. As you can see here from the chart, our incentives are going to grow from 40 upwards of 85% as companies move upwards in the value chain. Now, you may ask me why that is, and the reason is very simple. As you go downwards on the value chain, upwards on the value chain, on the upward stages of production, we have the most aggregate value for the country and also the highest spillover effect for the regional technology. And however, there is a problem, and this problem is the high cost. And so that is the reason why we have to concentrate our incentives and our money on this area. This structure of incentives incentivizes companies to verticalize their production and also ensures that they are not just going to maintain Brazil on its current state of just being an extractor and an exporter of rare earths.
In long term, we want to impact. No, in long term, we will have a lot of industries coming to this area. So due to low cost energy and also infrastructure, we have AI data tax, also BYD and others high-tech value chains. Due to that, the aggregate demand in that area will grow and it will protect from other supply chain blocks outside of the country.
Now going to our financial analysis, first analyze the production over time. If I see this following chart, what happens here is that in the initial years we have some negative cash flows, and not just that, we have low extracted rare earths. However, as we increase in more years, you can see that we increase a lot the extracted rare earths, we have to increase a lot the cash flows, and not just that, we achieve a plateau of a potential output of 151 kilotons per year, becoming Brazil the second largest producer in the world. However, it is not just oxides that we are analyzing. We are also analyzing all the value chain, and you can see that the multiplier effect of going through the value chain is huge. Next slide, please.
Now, you may ask me, is this worth it? And the answer is yes, across all stages of production. The capex is $16.8 billion aggregate, divided into mining, separation, purification, metallization, and the final magnet. As you can see here, the break-even prices per kilogram are in a range between $35 per kilogram and 81. And all of those are significantly below our floor price of $100 that will be sustained through contracts with bio companies. On the base case scenario, we have an IRR of 15.8%, and on the worst case scenario, we have an IRR of 13.6% scenario, which ensures that the returns are reliable even on the worst case. Next slide.
We will answer all the risk mitigations in our Q&A section.
That's why Brazil should develop a special economic zone, the northeast of Brazil, focused on rare earths. Thank you. We are open for your questions.
Thank you for your presentation. We will now move on to the Q&A session with our juries.
Okay, thank you very much for the presentation. So I have two questions. First is, this kind of a mineral investment usually is huge, long-term. Please elaborate the policy stability of the Brazilian market so that the foreign investor, they will have confidence that their financial model will build a reliable policy framework. The second one is rare earth is a very sensitive strategic minerals that may attract a lot of attention from a geopolitical perspective. So how does Brazil position yourself during this rare earth production process?
Okay, so let's start with the first question about how we can attain credibility from our investors. And returning here to this slide, we can see firstly that all of these policies they gain credibility because we're talking about a country that has a solid geopolitical background, that has a neutrality, a sort of premium that investors would translate into a price. Furthermore, these subsidies, they are structured so that we cover the main costs, the main threats, or the main hardships that firms face when they are trying to enter or develop any further stage of the rare earths segment. So the construction financing, it is a duration of 2 to 3 years, but it has a large impact on government revenue of estimated 5.9 billion. So we can practically finance the construction of the facilities that will process the minerals through this subsidy. And then the production subsidy, it enters in the same logic, but so that we can transmit to the firms the fact that we will sustain them for a medium to long term of 35 to 40 years. So this subsidy will continue in activity for decades, and this will provide credibility that would be very necessary for the product. So these are the two main subsidies that are signaling to the firms the credibility that we have in this product.
I'd like to confirm the second question, that is about the sensitivity of rare earth minerals and how do we adapt to this sensitivity, right? Yeah, so the main point that we thought about is that the difference and the tension between the United States and China, that the United States and the EU are looking for credible partners outside of China to invest in rare earth minerals, and Brazil is geologically the optimal point, because there isn't a single place on earth outside of China that has the capabilities, geographical and institutional, for example, a democracy, that Brazil has. For example, Brazil has the second largest reserve of rare earth minerals, and it possesses a ionic place that is the cheapest way to explore rare earth minerals that only China and the southeast of Asia has. So the United States and the EU have an enormous incentive to invest in Brazil, and even though it's sensitive, they have a credible partner instead of China, that is, they have a larger political tension, so they have an incentive to invest in Brazil. That was our rationale.
Okay, thank you very much for your presentation. My question would be really a similar question to your policies. So, if you have this kind of policy, so what is the situation of the policy recommendation as in the current fiscal stance? And how sustainable is that from a government point of view?
Just to make sure I understood the question, you want to know how the current policies in Brazil work towards
the policy recommendation that you propose.
Oh.
How is it? What is the position in the current fiscal stance, and what is the government support? What is the level of government support that can be, and how sustainable is that for the government?
Brazil recently passed a law that was with the objective of to support the creation of economic development zones. This allowed the country to pass the creation of those zones as simply a law, which simplified the process and reduced the bureaucracy. Based on that, and also on other economical special zones that Brazil created, we chose, here on the appendixes, this one. So we chose a specific group of benefits of targeting, and so here we organize the percentages and also the targets and the points that we are going to touch, which are based on other similar projects. And so Brazil is currently trying to support and develop economical special zones, and mainly on areas focused on exportation, such as this one. So the current fiscal ambient is very positive towards that. It's very supportive.
And I would just like to add to that the fact that when we look at our financial results, the government has a profit in the long term, and not even in the very long term. In the medium term, the government has a profit in the sense that we are going to spur economic development in that region that is very badly developed, and this is going to increase taxes that consumers are going to pay because they're going to live there. So in a very pragmatic sense, the government has an incentive to create this because he's going to make money. He sacrifices a little bit of fiscal amount in the present, but it has a high upturn in the medium term.
Hello again, guys. Quick question here. The projection is quite long, and I think the trend for electrification is it, but you're very reliant on EVs and renewable energy still being a source for mobility, like you said, BYD, or also even AI data centers. Did you consider the possibility in the future of other sources of energy, like if it moves to hydrogen instead of lithium batteries, if you move into more fusion energy, like in the US for the AI data centers instead of renewables? Does Brazil still play an important role? Do your materials still have demand? Or there is a risk that maybe in 10, 15 years we shift from electrification and we go into fusion and...
Actually, Brazil is like the country that have most of different energy types in the whole Brazil, in the different energy sources. And the Northeast we chose not just because it have many different energy sources that are the solar source, the wind source, and not just that, the water source. So the main point here is that our energetical value in Brazil, independently of the source of the energy that you want, we can just differentiate. So even though if you need to have a nuclear, at the top.
Yeah, and just to piggyback on that answer, it is actually very exciting that you mentioned these new types of energy because Brazil is currently being a pole for development, mainly on the northeast, for green hydrogen energy, and mainly to sustain data centers and similar projects. And so even if on the long term the energy profile and the energy aims change to that profile, Brazil is still a large player on that because it is investing quite early and it has a lot of natural advantages on that area.
Maybe I wasn't 100% clear. You are talking about producing energy, which is, okay, there's a lot of natural resources. What I'm saying is, the investments that you are for is to extract and process along the value chain materials that need to be sold to someone. But if, for example, EVs in the future, like BYD, they don't run on lithium batteries and they start hydrogen batteries, then they will require different chemistry and different materials. So did you account that if your materials are also valuable for other types of energy?
Yeah, when we look at the uses that we have for rare earth minerals, they are so big, they're so large. For example, we talk about EVs, but they are used in all types of cars, in all types of motors, and they are used for high efficient stuff. So for example, if we solve the nuclear fusion, we would still need rare earth minerals for magnets that are essentials for every single type of motor, unless we go to like a dystopian future. But as long as we need motors, we will need, for example, rare earth minerals, and there is, I believe, a very stable demand for this in the future. Thank you.
Thank you. Our judges may now proceed with the feedback throughout the competition. At this moment, our juries will take a few minutes to finalize their evaluations and confirm the final rankings based on the scores. While we're waiting, we would like to invite everyone to stay seated and give another round of applause to all teams for their hard work and dedication. And thank you for your patience. We'll announce the final results shortly.
Switzerland. Okay, so you guys can, and then the second one, also, a tie for the second place is Mexico. So the final one, the last one, which is, the first prize, goes to Brazil.
Okay.
Thank you, Jesse, for the announcements. The results for the business case finals have now been presented. We would like to extend our appreciation to all participating teams for completing today's competition and to our juries for the evaluation and time.